Right. The plane doors are closing and we are ready to depart. If you're all settled in and your right assigned seats. Good stuff. Right, good morning, ladies and gentlemen, and welcome back to this beautiful venue, Harsendal in Cape Town. Olga, thank you very much for organising such a wonderful venue again. I don't think it's going to be wine tasting afterwards, but I know there's going to be lunch. Right, but long way before we get there. Thank you all for being here. Really great to see you in person and not on webinars as we usually do. Before we get the proceedings underway, maybe just a quick few house rules. The presentation that you are going to see today will be recorded, all the presentations. We are going to share the presentations via link with you. It will also be on the Boutique Manager's website and the BCI website. So don't worry about it, you'll get all the presentations, and like I mentioned, it is being recorded today. For those of you who did not scan in yet, there's a QR code in the front. It's also on the screen at the moment, so if you haven't scanned in for your CPD points, please do so now. Also make sure that when you leave today, before you leave today, scan out as well. Right at the end, we'll put up another QR code. You'll have the scan out QR codes by the doors as well. Unlike webinars, we can hear your mobile phones today, so just check your phones on silent. I made the mistake the other day of not checking it. Right, from Robert, Walton, Tanya and Olga and the entire BCI team, we are immensely grateful for your continued support in making BCI an absolute huge success to be the fourth largest Manco in SA at the moment. So thank you very much for your continued contribution. We are really grateful for that. After each session today, we are going to allow for 5 to 6 minutes for questions and answers. So if you do have questions, I know there are roaming mics around here somewhere. It might be a little bit difficult to get to you, but I think the room is small enough. So if you have a question, please fire away. We'll repeat the questions anyway so that the entire audience can hear the questions as well. Right. If you look at the past 18 months, I would think it's fair to say that all narratives has been entirely wrong. We've spoken about things like transitory inflation. We didn't think rates are going to go up so steeply, so quickly. We thought that China is going to unlock and boost global economy. We thought the US is going to go into recession this year. It hasn't happened. So all these things that we spoke about very frequently over the past 12, 18 months, all incorrect. But it just points to you can't work on forecasting. You can't work on what you think the market or central banks are going to do. The only sane thing you can trust in is the type of asset managers that you deal with in managing your clients' money. The Fed again warned of inflationary fears. If we look at the US 10-year bond yields, it's the highest it's been since 2007, still going up. What does that say to us? You know, are we at the end? Are we at the peak? People saying, you know, we need to pivot. The Fed's going to cut. The Fed seems stubborn on cutting rates, and they're most likely going to keep rates higher for longer. We're going to hear lots about that today and where we're going to go from here. Like I mentioned, China, the unlocking of China, and the much talk about that dissipated very quickly. And we found that what we thought is going to be good for emerging markets, resources, places like South Africa, is not playing out. But what about places maybe like India? Can they take up the reins? But some of the topics that we will cover. Apart from the real estate crisis in China, the consumers lack confidence. And that seems to be a big holdback in what's happening there. Lots of plans in terms of fiscal stimulus in China, but very little action. Pretty much like SA. I mean, we've seen so many great plans of how to uplift SA's economy, how to get rid of load shedding, how to grow our economy. But again, you know, it's just plans on paper with very little action. Year to date, momentum in technology stocks is huge. We all heard about the Magnificent Seven, and that momentum seems to stick. Where is this all going? You know, and it sticks a bit like a suspended public protector in SA sticks to office. Right, not going to go there. On the local front, load shedding still hampering our economy or economic growth. It's got a huge impact on some SA companies. So how do you think about SA investing or SA equity funds or local equity when we do have economic problems here? Again, some of the topics that we are going to look at today as well. We frequently at these sessions discuss things like return on equity, but have you ever given thought on return on integrity? What is that all about? Right, that brings me to our first guest speaker of the day, Cynthia Schoeman from Ethics Monitoring and Management Services. Cynthia, thank you so much for being here with us today, and you're welcome to come to the front so long. Cynthia is extremely well published, books around ethics and corporate ethics, a regular speaker at conferences like this, so thank you for being here, and she does a lot of interviews on television and radio as well. So Cynthia, the stage is yours, and I just want to get you to the right slide, and I'm skipping through all your slides. There we go. Thank you so much.
Excellent. I'm going to guess that it will click over. I mean, I probably remember it, but it would be useful. I can see it over there. I can't see it here, but that's good enough. If you can see it, that's fine. So if, by the way, at the back, if you could get it on here, that would be really useful, but I'm sure I'll manage otherwise. So good morning, everyone. I mean, what a treat being here. I don't know this venue, and Cape Town was sort of home a long time ago, and it's always a treat being here, irrespective of the weather. The topic we're talking about, I feel like, and now for something different, but I really do think that ethics is a hell of a big deal in our country, and of course it's a very big deal in your world. So what I'm talking about is, as you can see, looking at ethics trends both locally and internationally, a bit of a whiz through it. I just selected a few of the top trends that I think are most pertinent, and I'll be posing what I think are really the pertinent questions. I don't nearly have time to answer them, but these are really the issues that I think you should be looking at. So the first one, of course, is corruption. And here, the issue of normalizing the way we do business. Let me just tell you, at IT, I still don't have those slides here, so it would be nice. The issue of normalizing corruption, do you know, I think that of course South Africa behaves like, we've cornered the market on corruption, and let me tell you, we've made a hell of a dent. I don't think we quite cornered the market, but we've certainly made a dent. But if we look at corruption globally, I think the Transparency International organization does a really excellent job. They do an annual survey, as you can see, the Corruption Perceptions Index. This is the most recent one. And here, what this index is looking at is public sector corruption. Let me tell you, red is painting a picture on that for you, and there's a lot of red. So as I say, I know that we're very caught up with corruption in our own country, but if we look at what's coming out of this, the overview, and this has been going for, I stand corrected, I think about at least 22 years, that out of the 180 countries, most of them are not making progress against corruption. The average score out of 100 is 43. I don't know about in your world, but 43 is a fail for me. but hold on, that's the average score. I think what's another interesting picture is when we're looking at regional results, we've got another oops again, because what I'm circling there is, of course, that if we're looking at my region, I'm just circling the lowest score, and guess where that is? So again, I do share it to say, of course, this is an issue internationally. But when we look at South Africa's results, I appreciate, yes, that we're coming out as an average, but as I say to you, I think that's a fail. Out of 180 countries, we came 72nd. This doesn't feel like we're doing well, as of course we are clearly experiencing. And here, if we look at corruption, can I tell you the slides aren't moving again, but I'm pleased to say I can see over there. That if we look at corruption, I actually chose this image because I almost want to say it looks like corruption is flourishing. It really does. And let's be clear, some people have made some very good business out of it. But here, I state, of course, the obvious. That can we please recognize that, we've always had these cute little lines of it takes two to tango and all that stuff. But actually, for every public sector official who solicits, accepts a bribe, please let's be clear, there is a citizen and or a private sector company who is the other part of that deal. And if we look at it then, here's the catch. Is it becoming the way business is done? Now, you can push back and say, gee, Cynthia, in our world, definitely not. But here's a perspective I'd like to share with you that I think really warrants our attention. Now, you can look at it and say 3 steps to normalizing corruption. Institutionalization, corruption gets embedded in systems and processes. Rationalization, you know what it is. Socialization, where we've got new people coming in and they get socialized to saying, corruption's not that bad. In fact, actually, it does serve us quite well. And so here you can say, okay, I've got that. Here's the big message out of this. Can we please recognize that when we're looking at normalizing corruption, the problem is no longer that there are a couple of bad apples and if we can just get rid of them. The problem, as in our public sector, is not a couple of bad apples. It is also the system. The two are almost mutually reinforcing. So I think that that's a huge point we need to recognize. As to a key question, I think there are so many. And when I say what should you be doing to mitigate the potential negative consequences, I'm not suggesting your industry is that tainted. But the context you're in has got a huge impact, and there are no points for being naive about that. The second trend I'd like to touch on is the imperative of ethical leadership. Now, you'd all be familiar with King 4, and I do like the fact that literally how corporate governance is defined in King 4 is the exercise of ethical and effective leadership. But I think we're up to speed on that. The point here is that who the leader is makes a huge difference. Now, let me just quickly put in a very solid red line there. I would really be very upset if you left here and said, honestly, we had this ethics speaker and Suvashi had a picture up there of Marcus Jooste. So, let me be clear, there is a division here between, the goodies and the baddies, so to speak. But who the leader is makes an enormous difference. And in this case, I don't think we should translate the leaders as being the 3.5 people at the top of the organization. As professionals, you are all leaders. And here's the point that you can't forget, is that of all the factors that shape ethics in the workplace, and there are a number, big surprise, leadership is the most impactful. Here's the curved ball. Can you see that ethical leadership is the most impactful, but so is unethical leadership just as impactful, as unfortunately we've seen play out in so many circumstances? What I want to share with you here is actually 2 models in terms of the bit of content that I'm sharing with you here, is 2 models of saying, okay, so how do we understand ethical leadership? And at a level we say, for goodness sake, we all got it. But I think these do add. The first one, I think, is a wonderful quote by Frances Hesselbein. She, in fact, ran the Girl Guides in America and was an extraordinary leadership expert. And I think that she captures this so very well. I know you can read it, I'll only read a few words for emphasis. That the leader of the future will not be the leader who's learned how to do it. You know, as she said, balancing the hows and the its. The leader for the future is how to be. Much more difficult. How to develop that quality, character, mindset, values, emphasis from Cynthia, principles, and of course courage. And let me tell you, it will take courage to take an ethical line in our country, often. Another perspective is in fact from one of my books. And it's a little extract. You can see a bit of a play on Mahatma Gandhi of be the ethical leader you want. And I'd like to share just those 4 points. That of course, as an ethical leader, of course you should not simply know the organization's values, you've got to live it. Of course, rules and regulations, you've got compliance support. That follow the golden rule. A really important point. And here, I mean, I'm sure we're all familiar with the golden rule. You know, it's common to almost all religions. Although I will share an amusing point. I was at a talk many years ago now, American speaker, and she was talking about the golden rule. And she suddenly stopped and she said, "Do you guys know the New York version?" So we said, no, we didn't know the New York version. So this is the New York version. I just add you can put anything in there for New York. And the New York version is the golden rule, is you do unto others before they have a chance to do to you. So this is not what we're advocating, but you get the point. I think the variations here. I think the last one's a really big one for our country. That we have seen so much leadership that is about self-enrichment. So much position of power that is about self-enrichment and personal gain. And of course, you know, I don't need to tell you the disparities in our country. Of course it has to be about empowering and uplifting others. And so the question I pose to you, a somewhat longer question here, is what are you investing in ethical leadership? And here, I mean, I think it's wonderful if we can take it for granted. You know, you can't take the weather for granted in the Cape, so why would you take this for granted? I think there's not a case of saying, listen, you're all the good guys, don't bother about it. The challenges that leaders are facing today, the need to grow more ethical role models, I think absolutely warrants that we do invest it. And then isn't it wonderful that, you know, ethics was a topic here? The third trend I'd like to look at is the issue of trust. And of course, this is a key issue in your world. And let me tell you, of course, trust is a key ethics indicator, and I would certainly say it's in short supply. And here again, wonderful research done annually by the Edelman Trust Barometer. This, as you can see, is the current one. And what they're looking at here in terms of the Edelman Trust Barometer and what this slide is looking at, is it's looking at the trust gap between business and between government. And you can see, excepting for right at the end, a couple of countries there, Singapore and the like, that government is very broadly less trusted than business. But what I want to hone into is trust in South Africa. Can you see that we have the dubious accolade of being extreme on that list? That we represent, out of the countries that were assessed in 2023, we represent the biggest gap between trust in government and trust in business. So you can see a 40% gap there. So, you know, you can say, Cynthia, we've got that. But this is my question to you. So in South Africa, business is coming out at 62%, granted versus government at 22%. Are you happy with a 62% score for trust? I mean, I'd have a big problem with that personally. And so here, I'd like to share a little framework for you that I think is very relevant. that we use this word trust, and sometimes my toes curl the wrong way when organizations use trust as a value. Trust is a consequence. So if we look at this, I think a simple framework that where you can achieve ethical conduct in an organization, huge bonus. Can you see that that creates the platform for having an ethical culture? You know, the way things are done around here. That is what builds, in my language, ethical capital, and I'll speak to that in one moment. Collectively, that is what achieves trust. And the final outcome is an ethical reputation. And just recognizing that flow, I think, is important, that an ethical reputation, of course, is the consequence of trust, and it in turn, as I just pointed out to you. And as Eugene introduced, I speak a lot about what I call the new ROI. You know, I promise you I've got the proper version, but I often do look at the issue of what is the return on integrity? And actually it's a useful concept to look at. And whereas, you know, return on investment, we would speak of in terms of financial capital, return on integrity, I look at in terms of ethical capital. And I know the various sources of capital, we all understand that. I really like the term ethical capital because the minute we put capital to a word, we understand that it is something of value. And so, as I say, ethical capital, let me share with you here. Yes, of course you can recognize it as an intangible asset. But I think when you look at the qualities of this particular asset, when I say it increases over time, you know, when your organization's been ethical for 5 minutes, hooray. But you know, when someone says, you know what, you can always deal with Joe here. Those guys have been in business for, promise you, 15 years, and you can trust them as honestly for all that time. Of course, it increases in time. But the catch is that unlike all the other assets, you know, you can't buy, sell, trade, whatever. You don't get to buy an organization and say, those guys got really good ethics, let's buy it. The catch, of course, is the bottom sentence, it must be lived to be earned. So the question I pose to here is, how do you score on trust building? I started this section by saying trust is fundamental to your world. But in fact, how I often phrase it is, as you can see here, that I really see it as the primary currency, and that there should be an absolute clear intention to protect, to preserve, and to grow it. And again, I reference that little flow chart, if you want, of saying recognize where it comes from. It's just a useful framework when you're looking at increasing it. The fourth trend I'd like to share with you is the issue of inclusivity. If you were looking at King 4, they talk about stakeholder inclusivity, and clearly we're looking at it as opposed to exclusion. And here I appreciate the very common terminology these days is DEI, diversity, equity, and inclusion. I, in fact, like DIB. I think diversity, equity, and belonging has got another whole dimension to it. And this, I mean, this is a huge international issue, you know, whether you're looking at an issue like international migrants or the like. I mean, we could raise more examples than we could count. And the issue of inclusivity has become one of the really big deal trends locally, of course, for the reasons we understand, but internationally a huge issue. And so consciously pursuing an inclusive path has become very much about what constitutes being ethical. On a lighter note, okay, I'm not clicking forward. If that could move, it's a really nice, you know, we can get so technical about how we define these things. No, it's not moving forward. Oh, no, it has moved forward. It's moved forward there, but not there. And I wasn't looking behind me. well, there you go. I'll just, you're not meant to as a speaker look behind you. So I had this wonderful view over there, but now it's all caught up. And I rather like this wonderful little extract of Spotify, you'd know the company, and I think that distinction of, diversity, you got to the party, okay? Inclusion, you got invited to dance, and don't you love belonging? They played your song. And I grant you, very light-hearted, although let me add, it is from the Harvard Business Review, so this is not, the local cheesy pep store magazine. But I think an interesting way of looking at it, of saying we can almost develop a pushback around saying, honestly, we're nice guys, just give it a break. And I think when you look at it in these terms, I think that's really informative. And a concept I use that I'll share with you around inclusion is I use the term ethical boundaries. As I said, King 4 talks about stakeholder inclusivity. I like the word picture of ethical boundaries. And it's almost like, a country has boundaries. So who's included? Who's included whom we consider, whom we take into account? But the big question is, who's outside that boundary? Who feels excluded? And here I think such an interesting quote, it's actually an American diversity consultant, that I think clearly, for reasons of our history, we can't miss the point that diversity is a big deal, but inclusion is the key issue. And I think here, capturing it, that we should be looking at inclusion intentionally, deliberately, and proactively, not after the event. And that wonderful sense of, as I say, belonging, that where we feel we belong, this is extraordinarily powerful. In fact, on a related topic here, I did a talk on some little while ago on kindness. And I appreciate kindness, comes up in many realms. And I spoke to kindness as inclusion in action. Because when we're kind to someone, I've actually then thought about what matters to you, or what are your concerns, or what are your interests. I have actually taken you genuinely into account. So as I say, kindness as inclusion in action is just another dimension. But if we look at the perspectives on inclusion, again, you can see here that out of the Edelman Trust Barometer, 6 countries come out as deeply, deeply polarized. I must say, I was surprised to see Sweden, but that's another story. South Africa's not bottom of the list. I just put them in sort of, I think they're in alphabetical order. No, they're not. But that's not an order. That, as I say, if we look at it internationally, 6 countries are deeply polarized. The further outcome is that, as we can see, a very high percentage, 53%, of countries, obviously including South Africa, hold the view, and I think this is quite alarming, that the country is more divided today than it was in the past. You almost want to say that can't be possible. And of course, here's the real issue, that the primary outcome, if not addressed, is of course to exacerbate the sense of inclusion, the sense of polarization. Again, we could write a laundry list of the factors that are giving rise to this. So I put it to you that the key question here is, what are you doing? And I pose the question here, both personally and organizationally. On that note, let me say I have a brief little video that I would like to conclude with, and that really poses my final question to you. That if we look at, here I'm looking at success broadly, but if we look at success, of course pursuing success as professionals is of course normal for all of us. Do we pursue success at any cost? Do we pursue it at the cost of integrity? Or does success without integrity really mean far less? So a quick video, which I think is a perfect ending.
Success without integrity means nothing. Your belongings don't make you a better man. Your behavior does. Integrity is how you behave when there's nothing to be gained. We make a living by what we get, but we make a life by what we give. Choose to strive for more, for better. Every hour of every day, be the man of today. Boss Bottled.
So can I thank you for your time and wish you a wonderful morning. Thank you.
Cynthia, that's been absolutely valuable looking at ethics and how it impacts our world, and food for thought there. And yes, it is valuable. You can put the word capital behind it. It's been great to have you here, and thank you so much for joining us. Right, our next session for the day is on local equity. Coming to the stage now, ready to go already, is Evan Walker from 361 Asset Management, Charles Keat from Methodical, Charles Gous from Batelier Asset Management, and Marco Barbier from North Star Asset Management. Gentlemen, thank you so much. Local equity, we all talk a lot about it. We don't feel so good about it if we look at the SA economy, but if you look at valuations on SA equity, it's most certainly well priced, especially if you compare that to global equity markets. And I know valuation metrics are sometimes a blunt tool, but sometimes clients ask us, do we need to include more SA equity now, or where do we go from here? Fantastic panel we have here this morning. Evan, thank you very much. You're up first, and looking forward to seeing your views. Thank you.
Thanks, Eugene. Morning, everyone. So glad I put my Hugo Boss on this morning. It's great to be here, back again. Time flies. It feels like the other day. Are we up on the screen, Eugene? Thank you. So yeah, ethics, great question, great presentation. Thanks, Cynthia. Before I start this presentation, a really scary stat. When ex-President Zuma left our SA government, fruitful and wasteful expenditure, according to the Auditor General, was at 80 billion a year. So fruitless and wasteful expenditure, according to the definition of their corruption, which is quite a nice sort of term for corruption, was at 80. Okay, thanks to Cyril, that's now at 180. Okay, so it's gone up 100 billion rand in that time frame under Cyril's management of South Africa. It's a scary stat, guys. And has anyone ever thought, we throw these billions around here every day, but a billion is 1,000 million. How do you manage to steal 180,000 million every year? It's just an unbelievable stat. Some of it does filter back into the real economy, but very little. I think most of it goes to Dubai and Saudi Arabia and all those wonderful places. But that's a shame. But thanks, Cynthia. It was well addressed. Guys, we're just going to we know we're talking about SA equity today, but just very briefly, let's have a quick look at the world. The world, pretty much from a manufacturing perspective, is in recession currently. It's good from the sense that goods inflation is coming down, and it's coming down fast, and China is exporting deflation at this point. Service inflation is still quite sticky, and funny enough, growth in service levels around the world is still quite strong, travel strong, etc. And at this point of the cycle, the worry for us is still oil, which has reached $95 a barrel. But pretty much the world is in manufacturing recession. That's where we are, and hopefully it'll start to turn by the latter part of next year if we see some cuts in rates. Inflation is coming down. Just saw the UK print this morning, came in 50 basis points under the estimate for the UK, so a good number, and inflation's falling fast. In the US, the big stymies there have obviously been wages, very sticky. despite what we hear and see, the US, guys, the US market is still pumping. Okay, the onshoring in the US is growing. We'll show you some graphs later, but the US is still pumping and wages have been sticky, and obviously oil at these levels is sticky, but inflation is coming down. The biggest single determinant for markets going forward will be the level of inflation and the long-term levels of inflation. And I won't delve on it too much because the fixed income guys are up and they'll do a lot on that. The 10-year is still elevated. The bond market's not yet believing, okay, that inflation is coming down. It's an important indicator, but it's also the supply and demand of bonds into the market, okay, and the amount of obviously additional credit that the US Treasury has been pumping out, and the lack of demand coming from the Chinese and the Japanese as they pull currency back, and also lack of demand from the US banks in what we saw earlier in the year in terms of the banking crisis. Guys, jumping to China, Eugene alluded to, China's a little scary for us. The market out there is tough. This started in 2021 with the fallout of Evergrande. The property market has hit a huge slump. It's falling. We've seen Country Garden. They didn't default on their bonds, but they came very close. But 75% of Chinese developers now are underwater in what's a very big sector of that market. The Chinese property sector is anything between 20 and 35%, depending on the definition of that market, in terms of whether you're buying the actual home itself, or you're buying the furniture to fit it, or the light fittings, or the tiles. It's a massive component of that Chinese GDP. Okay, and the full effect of that can be anything up to 35% of their total economic growth every year. So it's a huge number. Forward land sales for next year are down in the region of 30%. And that's got a spill-on effect in terms of municipalities, the cash they raise, their ability to roll out infrastructure. So that growth around China and the propensity to grow off this base, which we've seen so exacerbated for the last 20 years, is quite pronounced. And the big worry for us and the big worry for emerging markets per se is this China and this Chinese ability to consume going forward. The Chinese have been cutting rates. They've been cutting rates quite aggressively. I think they've been reluctant to pump too much credit back into this market, which it's been debt-filled. Everyone's painting a similar scenario to Japan, where we saw the stagnation for over 20-odd years, given the extent of growth that Japan saw in those early 80 years and then 20 years of nothing, and everyone's painting a similar picture. I think the Chinese realize that they've got to be relatively aggressive on this, but they've been reluctant to pump more credit in the market. The index is indicating, okay, that we should see some more reprieve coming there, but it's been slow, and obviously at the back of that, housing prices are falling, and the Chinese consumer confidence is at an all-time low. The biggest single problem for us, not only about the property dilemma in China, is also the fact that China now is losing substantial share of its exports to other countries. This onshoring, okay, and what we saw come out of these supply chain issues through COVID has now meant that Mexico sells more to the US every year than China. So this year alone, okay, Chinese exports to the US are down 25%. I mean, these are big numbers, guys. They're not 2 or 3 or 4%. They're down 25%. And Chinese companies, okay, are also not idiots, okay? They've also relocated a lot of their manufacturing to peripheral Asian countries to try pick up, okay, off the back of this. And a lot of them have also migrated to Mexico. But to me, this is very structural. Europe's doing the same, okay, off the back of obviously these supply chain issues and this dilemma we've seen and this argy-bargy fight between the Americans and the Chinese, okay, on tariffs, on semiconductors, and obviously this alignment with Russia, which has caused huge confusion in global markets. The US is also, they're not stopping fueling this underbelly of fire, okay? They keep flying a delegate to Taiwan. I think it's been seen, okay, by American businesses as fueling sort of a continual conflict in the region. And the Americans want American businesses to come back, okay, and obviously make America great again, which Trump started. But this is structural to me. This is not going away soon, okay? And you've seen US businesses impose massive duty structures on Chinese, okay, and Asian businesses. Likewise, we're seeing quite a big debate at the moment about EVs in Europe, which is at the forefront of the news flow, and a similar stats in Europe as they're onshore. So China really is in a huge dilemma currently in terms of its exports, and that to me is very structural because companies are coming onshore, moving aggressively, and obviously off of the back of that creating huge jobs internally in their own environments. Jumping to South Africa, guys, we've got this issue in emerging markets, obviously with China slowing aggressively and hitting potentially our terms of trade and our ability to sell exports. But then again, off this huge growth in EVs, we've seen a massive demise of our platinum sector pricing ability. We've seen obviously the basket price go down nearly 40% this year, and that's rhodium extensively, and obviously palladium and platinum, which goes into the back of vehicle sales. And EV sales in China escalated significantly towards the latter part of last year in incentives. And now you can basically buy an EV for under 20,000 euros in parts most of the world. So EV prices have fallen significantly. But why is this a problem? This is a huge problem for our fiscus. This is 60 to potentially 70 billion hit to our fiscus. These companies are underwater and they're not paying. So over and above COVID and the dilemma, and we'll show you in terms of COVID, we've got a problem coming on the fiscus. Guys, our domestic stocks in dollar terms here have done not much for 15 years. We managed to pick a couple of winners, but net, you've got to have quite a big slug, of rand hedge in your portfolio. That's what's held us up here, and that's where the JSEs, but domestic companies in South Africa, and we've had some winners, but overall have been quite sluggish, and we think those are going to continue to struggle in an environment where energy is going to be the key determinant. This is not my stats, guys. This is just what our electricity minister is saying. Additional 400 billion hit, to GDP from obviously from load shedding. An additional 77 billion hit to the fiscus, and another 860,000 job losses. That's what he's saying. I'm not saying that. That's what he's saying, but it's a scary number. Coming off the back of very lackluster growth in South Africa, and obviously this energy availability factor. I think it gets better. I don't think it gets worse from here. I mean, we're putting in a lot of renewables. We're seeing it come through quite fast. But just from a sentiment and investment point of view, I think it's going to take a long time. And a long time in our days is anything 3 to 5 years to sort this out and get it back on track before we restore confidence in people's ability to put capital back into the SA market in any great degree. So to sum up quickly, just our views on the globe. Global inflation is basing quite fast. Base effects are lovely things. Got a high thing. We spend our whole lives debating base effects as portfolio managers. Got a high base. It's coming off quite fast. Inflation will fall. Sticky for a while, but it's coming down. It'll be good for equities, but we have to wait. It's not going to happen tomorrow. We prefer developed markets. Developed markets are at full employment, guys. The US has never been this strong. So despite what the guys tell you today, the US is at full employment. If rates start coming off there, you want to be positioned in your portfolios. We're talking SA equity, but overall have a skewness towards the US still. Even at these valuations, in our equity fund where we have offshore exposure, we still have the biggest exposure to the US. Rate cuts we've discussed. We've discussed this onshoring ability, and that really is pumping these developed markets, more so than emerging markets, and not all emerging markets. In India, as Eugene alluded to, is doing exceptionally well off the back of the demise of China. And China, our biggest concern for emerging markets in terms of trade over the next 3 to 5 years. Current positions, guys, this is what a 361 fund can do for you in an environment when things are tough. We can move, and we can move quite aggressively. So we sold out of our platinums towards the end of last year. And guys, we're happy to sell to zero. We're happy to be aggressive and trade this market in stocks that we've done well. And I think this is where boutique managers can offer some value to you guys, as we just have the flexibility to move portfolios around far better than our counterparts with significantly bigger funds. So I'm not going to go through all those, but I just want to show you that we have these abilities. We move. We're constantly looking for the next best idea in the South African environment, obviously with a skewness towards some rand hedges. Our sector underweights, we're quite nervous, the South African economy still, just given, obviously, consumption and the hit from load shedding. We're quite underweight the retailers. It's hurt us in the last couple of weeks as everyone's getting a little bit euphoric about rate cuts. We still don't think there's a marginal job creator in this country yet, and in fact, we're quite negative around Section 189s and retrenchments in the platinum sector coming towards sort of middle of next year as we see the pressure on these platinum companies starting to grow quite fast. So we've got a skewness, okay, in the portfolios towards rand hedges and overweights there, and that's really represented by 63% of our portfolio in terms of what we term rand hedges, gold stocks. Naspers process we still own in the Chinese market. That's debatable. We're still waiting for hopefully Tencent to pay off in terms of its AI innovation to come through. And then certainly we're still looking for good opportunity in the SA environment. And the banks have been well positioned here. The banks, I'm currently at the RMB conference. I sat next to Sim, the CEO of Standard Bank last night, and some of the guys are relatively still confident on their ability to grow their African businesses and their South African businesses in a tough environment going forward. So the banks we still like, and then you can see, within those we're still favouring on the SA side. We've got some Grindrods, we've still had Bidvest, we've got some Astral Foods, Supergroup, and we started to make quite a big start in the property space in terms of mostly dual-listed properties or properties that have got some offshore exposure. The likes of Growthpoint, we've started to make a start in there and buying those on what we think are going to be relatively attractive yields going forward. So the property space, we're upweighting currently, just as we see, obviously, those prices coming back now, and bearing in mind that we do think we're at the top of the interest rate cycle and we should see some benefit of lower rates and lower prices. Guys, our funds have done well. We've got an SA equity fund that's beaten all benchmarks. It's a great building block if you need to use it. That's on the SA equity side. That's what we've just spoken about. And then again, guys, on the equity side, we now have 45% of the fund is offshore. If you use it, if you're looking for a building block, if you're not at 45, guys, you've got to ask yourself, why are you not at 45? If you need to be at 45, SA equity fund is now at 45, with obviously a bigger developed market positioning in the portfolio. We obviously got some South African assets. And again, as I sit here today, be careful on your construction of your portfolios. Have a good look through on your portfolios to ensure, okay, that your offshore component is not doubling up on emerging markets. You're not sitting with a double emerging market effect, i.e. big South African exposure and big emerging market exposure. Thank you very much. Appreciate your time. How do I get that to the next one? There you go. There you go. Thank you.
Morning, everybody. I'm Charles Keith, co-portfolio manager together with Eddie Bresiker of the Methodical BCI Equity Fund. As many of you might know, this is a data-driven or quant fund. So if you have any questions when Eskom is going to run out of diesel or when to buy SA Inc. stocks, I think rather ask one of the other panelists. So quant investing is nothing new in the global investment industry, but when we launched this fund in 2016, it was a bit of a novel concept in our industry. Most of our funds have always been more traditional fundamental funds. But we have gradually come to accept quantitative investing. In fact, Stanlib, one of the largest CIS managers in the country, recently announced that they are replacing their traditional SA fundamental equity fund with a multi-factor systematic approach. So even though there's growing acceptance, there are still some misconceptions about what quant investing is. The first and most common misconception is that all quantitative investments are smart beta. And that's 50% correct, because all smart beta funds are quant funds. But as the name implies, smart beta starts with beta or market cap allocation, and then it's multiplied with a factor. So take, for instance, Anglo, that might be 10% in the all-share index. That can be up-weighted to 13% or down-weighted to 7%. but your main allocation driver will still be your market allocation. This brings us to the fact that not all quantitative processes are smart beta processes. Take, for instance, our methodical BCI equity fund. We don't even look at market caps. We look at price and volume. And then a quantitative process can also build in other factors or constraints. For instance, we have a maximum allocation limit to 5% of shares to reduce single stock risk. So going back to the Anglo example, where Anglo might be anything between 7 and 13% in a smart beta fund, it might be anything between 0 and 5% in our methodical BCI equity fund. So as you can see, it's a very different process, a different outcome, and we are totally benchmark agnostic. And the second misconception is that all quant funds just use big data that gets fed into a black box and it spits out alpha or a portfolio. Fortunately or unfortunately, this is not the case. In fact, we had an actuary sitting in our office a few years ago. He was busy doing his master's, and he was convinced he was going to solve the market with big data and brute force. And after a while, he got a bit despondent because the market can't be solved. So quant investing is just like any investment style. It starts with an investment hypothesis or a story. We then collect the data to test this hypothesis. We transform this data into rules. We test this. If we prove our hypothesis, this can be implemented in and used in a portfolio. If it's disproved, it's back to the drawing board. So this is not to say we can't use AI or machine learning, but that will just be one of the tools a quant investor will use when making decisions. So the factor we look at for the methodical BCI equity fund is the momentum factor. We buy stocks based on the probability that stock trends are going to continue in the future. You get two types of momentum. First is time series momentum or trend following. Think of this as a 200-day moving average of a stock. If it's above it, you buy the stock. If it's below it, you sell the stock. And then you get relative momentum. This is where you compare stocks to each other. So you buy the relative best performers. The methodical BCI equity fund employ both these momentum styles. So does momentum deliver alpha? Here we have a graph of the past 30 years. In dark blue, it's the S&P 500 index. This is a market cap weighted index, same as our all-share index. As many of you might know, this index outperforms 70 to 80% of active equity managers globally. Then we have the red line. This is the MSCI US Momentum Index. There's a ETF offered by BlackRock iShares that tracks this index. This is a smart beta index. And then you have the gray area. That's the accumulated alpha. As you can see, it's almost 2% per annum over the past 30 years. And the interesting fact about this is all this alpha was accumulated after a study was done about the momentum factor 30 years ago. So even after they gave us the secret sauce, this factor still outperformed. So this is not to say it's all smooth sailing and 2% every year, but investing based on this style does keep the odds in your favor. So digging a bit deeper, why we believe momentum investing will deliver alpha in the future. If you look again on the left-hand side, that's the S&P 500 index over the past 80 years. So you can see it goes pretty much bottom left to top right. And this is a market cap index, so for a share to get into this index, its market cap needs to grow more than the smallest company. And if it wants to stay in the index, the market cap has to relatively outperform the other shares. So this is an index of winners. There's survivorship bias in this index, and over time, this index will trend up. There's actually a close to 60% chance that the market will be up next month. Another way to visualize this is spinning a roulette wheel with your 60% chance of winning. So after just 200 spins, you start making money. So there's no use betting against this trend because in the end, it's trending upwards. Now, unfortunately, markets aren't binary. Being right 60% of the time doesn't mean you're making money. And this is because stocks have what we call fat tails. And the problem with these fat tails is you can't define it. On the left-hand side, if a share was down 90% last week, it can be down 90% again today and 90% again next week. On the right-hand side, if a share doubled last week, it can double again today and double again next week. And this is where behavioral biases also comes in. So investors tend to hold on to losing shares too long and hoping for a miraculous recovery. And then also selling those winners too quickly because they are scared they're going to lose their gains. This is called the disposition effect. So ideally, you want a strategy that takes away human emotions, cut out as many of the left tails and capture as many of the right tails. And this is exactly what a momentum strategy will give investors. We cut the losers short while riding the winners much longer, while taking away all human emotions. And on the right-hand side, this is a share attribution of the methodical BCI equity fund over the past 3 years. As you can see, we have a few big winners, over 8%, some of them, and then our losers we cut short, only 2%. So, and just like the roulette wheel, the more we employ the strategy and the longer we employ it, the better these figures will look. Then looking at fat tails and stock returns, I mean, there's hundreds of examples of fat tails in markets. I think recently Silicon Valley Bank struggled and then went bust. That's a left tail event. On the right-hand tail event, NVIDIA is a perfect example, up almost 200% this year, even beating earnings. And then local markets, I think everyone knows Steinhoff. Interesting fact is before it fell 95%, it was already down 50%. And then after falling 95%, it fell another 95%, currently trading at 1 cent. And then on the right-hand side, a perfect example is Thungela. When it listed, it quickly doubled again a few times subsequently, returning almost 1,800% to investors. And this is again where a momentum-based strategy will help investors to cut those share like Steinhoff out and ride a winner like Thungela. So markets are dynamic. It constantly changes. New information comes to the market. And we believe that all information is already in the price, so we only look at price trends. And as the price trend increases, the probability of outperformance increases, and we upweight our allocation to the share. As the share trends downwards, we will decrease our allocation. This is a constant process. So in the end, we want to compound our good decisions while cutting our bad decisions or limiting our bad decisions. And this is, again, while keeping probabilities in our favor. Just as a summary of philosophy and strategy, we believe price momentum is a permanent feature of equity markets. Changes in cycles and technology and risk environments, and our response to those changes create trends in market. If you just think about changes over the past century and the sectors it created, the internet, GPS, internal combustion engines, EV vehicles, it all creates industries and new trends, and a momentum investing will ride these trends. Quantitative investment approach removes all behavioral biases. It remains rational when markets are irrational. And it's repeatable and scalable. And we follow strict rules, and Ed and I don't see ourselves as portfolio managers. We manage the risk of the process and the risk inherent to momentum investing. And lastly, some performance. On the right-hand top, we have a correlation matrix. This is us versus the 5 biggest local equity fund managers that also has offshore exposure. As you can see, our highest correlation is their lowest correlation to the market and the peer group. It's a different process with a different outcome. And this is good for blending with other strategies. And then lastly, on performance, because it's an equity fund, we believe you shouldn't look at anything shorter than 3 years rolling performance. Here we have the 5-year rolling performance. As you can see, a consistent outperformer above the peer group. And we believe because this strategy constantly adapts to the changes in markets, and it keeps the odds in our favor, this consistent outperformance will continue in the future. And as time increases, again, like the roulette wheel, the better this relative outperformance will look. Sorry again for not giving my view on China or South Africa, but again, I think you'll get enough of that from the other panelists. Thank you very much.
Wat se knop druk ek hierdie ene?
The next.
Morning, ladies and gentlemen. I'm Charles Goos from Battelier Capital. Let me just move over here to our slide. I'm here to tell you about our business, and thought today would be appropriate to sort of give you a bit of insights into how we look at equities. So it will be a bit more of a stock-specific presentation. So Battelier Capital was founded as a hedge fund management business in 2004. We launched our first hedge fund in 2005. So the business has got longevity. We've been around for quite a long time. Given our hedge fund background in most of our products, which has got a capital preservation element, there's an acute focus on risk and downside protection. We apply a consistent investment process across the funds that we manage, where the implementation per mandate obviously differ. And we don't like to constrain ourselves to any specific investment style. It's got a flexible approach towards stock selection. I think what's also nice is the business is 100% independent. All the key individuals that's involved in the business as shareholders and active on a daily basis. We're also not a large business, so our smaller size enables us to access a wide pool of investments on the JSE, specifically in the lower market cap equities that's available. But we're here to talk about the Battelier BCI SA Equity Fund. As the name say, this is a South African-only equity fund, so again, a building block kind of approach that needs to be followed with this fund. Quite interestingly, this fund has gained a cumulative 54% since 2021. So there is money to be made in South Africa, and has consistently outperformed its benchmark over the last 4 years. On the right-hand side, you can just view the longest-running, long-only segregated mandate managed by Battelier Capital, which has been annualizing at just over 2% net of fees relative to its benchmark. So what we're going to do today is I want to try and address two sort of common issues or questions that we get when we engage with clients. So firstly, it's to get some insights into our investment process and how we look at companies. And secondly, as always, the question about how do companies grow in a no-growth environment. We've got very sort of limited macro environment. There's been lots of talk about all it, and we're all very much aware of the headwinds facing us. But how do companies grow, and how do they do better? Now, Shoprite has been a business that we've owned in the fund and has done very well, where Pick n Pay we've not owned in the fund for various reasons that we'll discuss. So in our opinion, Shoprite's got a very clear very clear strategy with brand focus and segmentation that allows them to grow across the different sort of markets that they serve. The business has got an entrepreneurial culture, and when we review their delivery, we've got an excellent execution from the management team. Also importantly, the business has continued to invest via capital expenditure in the growth of its business through the cycle to entrench its competitive advantage. Where's my slide? There we go. I don't think I put that in there, but it looks quite nice. In our opinion, Pick n Pay's got a very unfocused strategy. They've done a number of restructuring efforts over the last couple of years without any visible improvement in the bottom line. There's been multiple leadership changes, and the business had to rely on external talent to lead the company. Our analysis also indicates that they've underinvested in growth via capital expenditure relative to their peers. And they've been slow to implement centralized distribution many years ago. They've underinvested in the value retail segment, which is the largest portion of the retail market. And they've been late to identify the online food delivery opportunity. So let's look at a couple of extracts from the financial statements and the comments made by management. This is important as it allows us to evaluate management's view of where the business is going relative to their delivery. And it goes back to 2011. In 2011, Nick Badmington talked about future growth and continued success in the medium to long term. In 2015, his successor, Richard Brasher, talked about the business being well positioned for sustainable long-term growth, and followed that up in 2020, talking about a leaner, fitter business which delivers consistent turnover and earnings growth. The recent CEO, Peter Boone, in 2023, came with a bold new strategy to sustain and grow the business and talked about its strong growth engines in Pick n Pay. However, what we find very interesting, if we look at the operational results of the business, it does not tie up with what Pick n Pay management tells us. Their market share has gone from approximately 30% to 20% over the last 5 years, while Shoprite's market share has grown from the low 20s to the mid-30s over the last 5 years. What's important is Pick n Pay's investment case over the last couple of years has always been based on a margin recovery that leads to outside earnings growth. And sell-side analysts has always been quick to incorporate this into their valuation multiples, which led to a fairly high valuation for Pick n Pay relative to our internal assessment of its prospects. And you can see in the red bars how Pick n Pay's actual earnings delivery has been significantly less than what the market has been expecting them to do. Another example of this is how they announced their recent e-commerce strategy, and sell-side analysts were quick to incorporate that into their valuations. This particular analyst talks about a bold e-commerce plan that could be a game changer for Pick n Pay. At the time, Pick n Pay was trading at 55 Rand a share. They came out with a target price of 97 Rand. You can currently buy Pick n Pay for 34 Rand. What was very interesting as well is that the same analyst, 1 year later from the same research house, came out and downgraded Pick n Pay and called it a potential value trap. Now, this is important to review because these kind of things highlights to us why we do internal research, why we rely on long-term historic information and conduct a robust review when we look at management execution, especially their past execution, before we put any weight on their future potential performance. Now, this is the big difference between the two businesses. We talked earlier about how we want to compare companies and why do we think certain businesses will do better in the future than other businesses. The red bar shows you how Shoprite has invested into their business to maintain the business and to grow the business since 2010. You can see how the business has consistently invested through the cycle. In fact, in 2024, Shoprite will spend 8.5 billion Rand on capital expenditure. It's 50% of Pick n Pay's current market cap. If we include 2023 spend, it will be 90% of Pick n Pay's market cap. So the red bars absolutely dwarfs the blue bars, and that's why the Shoprite will grow faster than Pick n Pay into the future. You can also see how Peter Boone's recent growth plan in 2023 requires higher levels of capital expenditure, and we'll touch on the problems with that on the next slide. If it will go ahead, there we go. Sorry, I'm back to that. So the problem that Pick n Pay faces is they're competing against a very fierce competitor with balance sheet capacity. We can see in the red bars that while Shoprite was spending that significant amounts of cash, the business was also generating an equivalent amount of cash. So the balance sheet has continuously been managed in a net cash position. Pick n Pay, on the other hand, is in a phase where they have to catch up with CapEx, but they have to fund this via debt. This is a difficult environment to be in, as that debt level can only be extended to such an extent before you're running into trouble. When we again talk to Shoprite management, they talk about precision retailing, and we would dare to sort of mention that we think their competitors are engaged in much more of a reactive retailing strategy. Checkers is a good example of how Shoprite has been very clever to target higher LSM groups. Shoprite was traditionally a low-end retail sort of offering. Now, Shoprite was very clever here. So they improved their fresh and speciality offering, and obviously subsequent to that also launched their online delivery platform. But what this meant is they started taking on Pick n Pay, Woolworths, and Spar in this high LSM category that they've not previously been active in. And we can see on this chart that since 2019, Checkers has grown their revenue by 12.8% per annum, while Pick n Pay, excluding Boxer, which is their low-end retail offering, only managed to grow by 1.5%. Now, while we're on strategy, let's look how the different companies have moved into the online environment. In 2019, Checkers delivered Checkers 60, or come to the market with Checkers 6060. Very importantly, this was an in-house developed application from ShopRite. In response, Pick n Pay went out and acquired the Bottles app, which is a sort of a very small liquor delivery app. So they didn't have the in-house capability to develop their own solution. Then the same sort of thing happens in 2021. ShopRite realizes that you need to own, or at least partially own, your last mile delivery so you can control the service levels to your clients and how your product is distributed. So they enter into a JV with their distribution partner. Again, Pick n Pay is reactive and ties up with Takealot, partially also because they don't have the internal skills to service that need. And recently, this was also very interesting. My wife actually just sent me a picture of it yesterday. She was excited to subscribe. But ShopRite launched its first grocery subscription model, very similar to Amazon Prime, where the customer will receive unlimited deliveries on a monthly basis, in-store discounts, all sort of vouchers and the likes. And the real idea behind that is, again, to target this higher LSM consumer and capture a bigger portion of that wallet that is available to them. So very interesting to sort of compare the different strategies of the companies. And this execution is clearly played out in the trading profit growth of the different businesses. So here we look at ShopRite and Pick n Pay's SA trading profit. ShopRite has compounded at almost 12% per year since 2010, and Pick n Pay at 5.1%. What is also very interesting is to look at that period from 2019 onwards. That's really when the Checkers strategy started hitting its straps, and the Pick n Pay operating profit largely flatlined. Shareholders also enjoyed this benefit with a compound annual return of about 10% per year for ShopRite versus negative 12% for Pick n Pay. So in conclusion, if we look at our investment process, it's very important for us that we need to look at past execution and a robust sort of review of management's delivery relative to their outlook statements. In our opinion, investors need to be cautious of major strategic shifts, especially by new management teams, and rather look for continuity in the strategy of the business, as well as management with the strategic ability to deliver on that. Very importantly, it's difficult to fix struggling companies, and the good companies will continue to take market share from those that's finding it difficult. They say elephants don't gallop. We'll argue differently in this scenario and continue to expect very strong earnings and revenue growth from ShopRite relative to its food retail peers. Thank you very much. That's the story.
Brilliant. Good morning, everybody. My name is Marco Barbieri. I'm a manager on the North Star BCI Equity Fund. And hopefully I create a bit of a more positive kind of perspective here, just highlight some of the opportunities that we're seeing in the equity space. And, and obviously highlight some of the risks and how we triangulate, the opportunity taking into account the risks. So South African equities haven't been a great place to be in or to manage over the last 5 years. If you look at returns in dollar terms, South Africa has done -1% annualized over 5 years, and that compares against the US that has done 11%. The average emerging market has done 1.4% over that period of time. Obviously, that's skewed by China, which has been very weak. Year to date, the chart on the left, similar kind of dynamic. Japan, US, Europe, all doing double-digit returns in dollar terms. and South Africa after quite a diabolical August, trailing 6%. This year, slightly different dynamics. The rand is playing a different role. What's perhaps a bit more interesting, and I think it's quite surprising to a lot of investors, is the fact that if you look at returns over 3 years, it actually hasn't been South African Inc. that has been a drag on performers. It's actually been global dynamics that have dragged the index down. So if we look at the composition of the index, 40% sits in basic materials and technology, and it's clearly exposed to some of the global demand and supply dynamics. Technology, Naspers process exposed to China. And that 40% of the index has been quite a big drag. The Caps Fix in rand terms has done 14.6% over the last 3 years. And if you look at the South African sensitive sectors, financials, some of your industrials, your consumer sectors, over the last 3 years have had healthy double-digit returns. And to put this in perspective, over the same time, we've had peak load shedding days, we've had riots, we've had floods, we've had the worst consumer situation that we've had in decades. So, what I'm trying to point out is that valuation plays a massive role in understanding the investment case of a position. This is now looking at valuations. So here we look at the North Star buy list discount over time. It's a shorter period of time. We're looking 18 months. And it's a benchmark that we use to understand how cheap or expensive the market is. So the higher the number is, the higher the discount to what we deem to be fair value. And over the last 18 months, you've had 2 or 3 great entry points to the market. The very notable ones were in September and July 2022, when arguably we had peak pessimism in terms of load shedding and global dynamics were playing out. But had you invested in those 2 points, you would have generated significant returns after that. Where we're sitting now is that we see about 20% discount to fair value of our equity portfolio, which we think is fairly attractive. But to put it in perspective, we've seen these discounts on average over the last 3 years. So what we think is happening is that the average investors are assigning a larger risk premium to our assets, and you're seeing a similar dynamic in the bond market where bond yields are trading at very elevated yields. So we're in a reasonable valuation framework, but what is exciting potentially for investors like ourselves that try and extract active management alpha is the fact there's a larger dispersion between sectors. So if we just look at the PE multiples of the various sectors relative to their 5-year average, what we're seeing is that broadly most sectors are trading at a lower rating than what they have over the last 5 years. And, to put that in perspective, the last 5 years haven't been great, and we've had a broad de-rating of the entire market. And, and we're seeing very punchy kind of discounts in the more cyclical areas of the markets for obviously good reasons, like clothing retailers, food retailers, which have obviously been clearly affected by load shedding dynamics, and the general industrial space, which has been quite a tough space to be in. On the other side of the spectrum, defensives are trading a bit more punchy, closer to fair value. What we're seeing from an asset class perspective, so fortunately at North Star we've got a fixed income and global equity team, so we can leverage off some of their views. And we meet once a month to kind of discuss asset allocation decisions. And each team puts forward 3-year prospective returns to the team. These are all in rand terms. And what we're finding at the moment that we understand that there are risks in these numbers, but we're seeing pretty good double-digit returns for SA equities on a prospective base over the next 3 years. We see good value in South African bonds. Global equities, to a lot of people's surprise, we see valuations to be fairly punchy. And this is at a fairly constructive rand view. We think that the rand is trading at fairly weak levels. So on a relative basis, we think that South African equities do offer opportunity at current levels, certainly versus cash and bonds. I'm certainly not advocating that you tilt your entire portfolio in cyclical South Africans, you disregard the defensives, and you disregard the rand hedges. The way we construct the portfolio takes into account risk and return characteristics. In this chart, we're looking at some of our own numbers. On the y-axis, we've got our prospective 3-year return. This is all based on bottom-up work. And on the x-axis is a measure of risk. So how difficult is it to value these things? So we like to look at the fan of outcomes of valuation for various companies. So for example, Anglo American is going to have quite a wide fan of outcomes compared to arguably Standard Bank, which is a bit more predictable. So if you actually look to optimize a portfolio based on these kind of characteristics, you're going to require much higher returns out of PGMs, for example, which, sure, have got a very negative bear case, but have potentially got a bull case as well. And where we're seeing value at the moment is we're seeing opportunity in the drug retailer space, healthcare, hospitals. We're seeing value in diversifieds for the first time in a very long time. Naspers, we see value. We think there's plenty of risk in that space, as been mentioned. And probably on the more negative side, on a relative basis, we think that gold has kind of had its turn. The more defensive food retailers and telcos are looking relatively more expensive. So just to kind of capture the themes that we're kind of playing in the fund. The fund is built on a bottom-up perspective. We then optimize based on risk-return characteristics. But if we look at the fund on an ex-post basis and we try and extrapolate some of the themes, what we're finding is that there's a couple of clear themes that emerge. And the most interesting one to us is that despite you've got tough macro out there, the fact that government has been failing in many areas of the market has created massive opportunities for the private sector. So just think of Transnet failures in logistics. It's created opportunities for many private operators. We look at infrastructure spend by the state has been reduced. It's created opportunity. Energy, load shedding, we've seen many companies that have benefited from that. And we can talk about many areas where schooling. So I can talk about many stocks that we like in that sector. Probably the three that stand out at the moment are Bidvest, Supergroup, and Roinet. Bidvest has clearly taken advantage of renewable energy kind of wave and the logistic deficiencies that Transnet has kind of enhanced. Supergroup, diversified logistic player, the exposure to Australia and the UK. South African business is doing very well, and that's another example of opportunities that are created in a perverse way. And the final one in the mid-cap space is Roinet, which is underperformed for a very long time and now benefiting from some of the renewable dynamics. COVID-19 recovery, that's another theme that we're playing. I mean, it's amazing that COVID was 3 years ago, and some sectors have recovered very quickly, like mining, but other sectors haven't. And you look at South African hospitals, they're not yet operating at capacity. That is probably one of the more controversial kind of calls that we are making. Some people think that it's a structural decline and it's never going to return to normal. We don't see it that way. We think that capacity is going to keep on improving and the mix of surgical to non-surgical, higher margin business is going to improve. So we like that space. We think the valuations are supportive. And then you look at insurers. Clearly, the short-term and the life insurers have had a negative impact because of COVID and are now making a strong comeback. So we like that space. Interest rate peaking has certainly created opportunity for banks, from a margin perspective. In that space, we like Standard Bank and Absa. Standard Bank has got a great African franchise, which is now 50% of earnings. And it's doing very well. The story with Absa is slightly different. After the Barclays sale, we felt that there was massive improvement to improve the franchise and subsequent returns to improve. Inflation moderating has been obviously quite a key theme. The sectors that should benefit most from that theme should be the retail and the general industrial space. And I think that the market is certainly pricing for very protracted weakness in that space. And we might be very early there, but we think that valuations are starting to look more and more attractive. Mr. Price is a company that stands out. Once one of the darlings of the market, now it's trading on a 12 PE. We don't think that the investment case is broken, but we can go into that some other time. Dis-Chem, a bit of a growthier stock, which we think has got good legs to operate. These are all companies that we think that have got self-helping levers, don't necessarily need the macro to improve. And the third one is Remgro, which Diversified Industrial Group. They're working quite a bit on the discount on the group. It's a company that we like. And then the commodity space, obviously, that is exposed to global drivers. For the first time in a very long time, you've had quite a strong derating in that sector. Anglo's was in pound terms 44 pounds not too long ago, and now it's at 18. So it's certainly giving you much better medium-term entry points. So at the moment, based on the risk-adjusted basis, we're still neutral on PGM trade and gold, but we're becoming increasingly more constructive on diversifieds, where we back Anglo's and South 32 based on the mix of commodities, which we think are going to perform over the medium term. And then I just thought that to finish off the last two slides, I'd kind of introduce the team. For those that don't know North Star, we've been around for about 10 years. We've got an investment team of about 14 people, and we cover fixed income, global equity, and local equity. On this slide, we're showing the faces of those involved on the local equity side. And I think that, with the number of personnel that we have at the moment, we can do just as good coverage. We're certainly covering the top 40 very well. And at the moment, we've got, opportunity to really explore great opportunities that are out there. And finally, the business has been around for 10 years. It's always hard to kind of set down an investment process and make sure that it performs. Over the last 3 years, we've certainly put a lot of effort into portfolio construction. We've rated ourselves to be stock pickers for a very long time, but the local equity market is quite a difficult beast in terms of the different dynamics that are playing out. So we've certainly had to sharpen up our skills from a portfolio construction perspective. And we think that what we've built over the last few years is certainly going to go a long way in generating competitive returns over the medium term. Thank you.
Thanks a lot. Thank you very much. Insightful. Any questions from the audience? You can really ask. Right. Maybe from my side, very, very quickly, and Charles Keat from Methodical, if I can maybe start with you. I want to play Mythbusters with you. So if you look at momentum investment style as a concept that you apply in quant investing, a lot of us understand that momentum as an investment style normally only works when you have stronger markets. Is that true, or can momentum as a style work through different market cycles as well, and how?
So momentum investment style will work through different cycles, but it does struggle at the inflection points. If you think of 2008, as the market starts crashing, you will start moving into defensives, the relative strength shares, and then it will struggle getting out of this hole because you're stuck in defensives. In strong trending markets, momentum style will perform relatively well. And that is why we employ both trend following and momentum. So if there's a strong trend in the market, we'll have more momentum shares. If there's not a strong trend, we'll move closer to the market and have a bigger market allocation.
Right, thanks for that. Myth busted. Right, exactly. Evan, I know you mentioned in your presentation, if you don't have 45% global, you've got a problem. Although you've got an SA equity. Your SA equity fund beat your equity fund over the past 12 months, so SA equity worked. I just want to talk about the RAND quickly and how it can potentially impact on things like RAND hedge stocks being held in a portfolio. Yes, you've got some portfolios with global exposure as well, but it's always a question that clients ask us very frequently. And we've seen how things for the RAND can turn very quickly on a positive note if we just get less bad news, no bad news. And what could the case be, if the Fed starts cutting rate for a US dollar that's too strong? Maybe just your quick views on that. Is it something, are we still betting against the RAND for some time to come, and we'll cross that bridge when we get there when the Fed starts cutting rates?
Thanks, Eugene. I think it's a great question. Everyone asks us that all the time. I think you've got to look at it in two different silos. I mean, what you do see is when the rand strengthens generally, that's off the back of strong global markets. So the rand generally doesn't strengthen if global markets are not strong. I mean, there's been a couple of periods of time when that's happened. So the view is that if you got your 45% offshore, you've got to make sure it's working for you. Okay, and you are going to go through patches where the rand pulls back, global equity funds don't do as well. I mean, there's obviously short-term scenarios, okay, which do hurt you in over 12 months, Eugene. I'd like to say that over 5 years, the fund is significantly better than the SA equity fund, but we'll stop there. But Eugene, yeah, there are periods of time, okay, where you're going to get slightly, and it's a percent or two. But bearing in mind, the starting point is always to say that's a block of investment there, and that block of investment can invest in 10,000 companies versus 80 on the JSE. So, make use of that. All I'm saying is make use of it, okay, because good managers should use that and use that to their ability over time and find those opportunities offshore, okay. So there are periods of time where you've got to say to yourself, okay, I need to suck it up. The rand's pulled back 5%, offshore's down a little bit and it's hurting me. But over the longer term, I think you've got to take the view that there is so much more opportunity offshore, okay, and you need to be there and you need to find funds that can do it for you. So I think it's a very short-term synopsis when guys go, oh, but the rand can go and strengthen tomorrow, the dollar strength. Look, quickly on the dollar, there's not any other greater currency in the world. And so everyone goes, oh, the dollar, the dollar, the dollar. But, where else do you put your money? I mean, every single other country in the world has got more debt than the US government, okay? And it hasn't gotten a market fully. Where would I rather bet my money on, okay? The US taxpayer, okay, or the South African taxpayer? I'd still rather bet on a 5-year view against the US taxpayer than the South African taxpayer, or likely any other taxpayer in the world, barring maybe the Aussies and the Norwegians or the Swiss or something. There's a couple of select markets around the world that could potentially beat the dollar. But I'm not a complete dollar bull, but I think in a relative term basis, it's hard to deny the fact that you need dollar earnings.
It's definitely also not a new BRICS currency, but let's park it there. Thank you very much for that. Charlotte, Gous and Marco, very quickly, if you lended your ears to macroeconomists over the past 18 months, everything would have been, or you would have hit the wall, right? Because everybody got everything so wrong. Very quickly, in 30 seconds, lessons learned over the past 18 months and have that impacted on your investment process or philosophy?
Yeah, I'll start off. Nothing's changed from our process point of view. I think lessons learned, it always comes back to equity selection first. So firstly, we need to like the businesses that we invest in. The macro helps us to manage the risk around that process, i.e. how much exposure we have, sometimes, really very much around Chinese exposure, resource demand. That's where macro would come in. Yes, everything has been slower than expected, and the US has been stronger than expected, in a nutshell. But fundamentally, it doesn't change our process and the kind of businesses that we want to invest in.
Thank you very much, Marco.
Yeah, I think similar to us, it didn't change our investment process. We continue to maintain the same valuation framework. The macro can be reflected in the valuation work. So some of the inputs would have been kind of stretched to some extent. To be honest, we have been surprised by the level of pain that we've seen in the consumer space, but it certainly hasn't changed how we look at equities and how we approach the case.
Thank you very much for that. All these managers, of course, over the investment periods that you are looking at are top quartile performance. So, gentlemen, thank you very much for doing great work for our clients out there, and we will catch up with you during tea time as well. Thank you very much. Right, just latching onto that last comment that I made in terms of how macroeconomists got everything wrong over the past 18 months. Our next session today is on local bonds. Beginning of the year, we said local bonds are absolutely fantastic, great yields, and clients can actually find real benefit from a bond market. Other than the last couple of weeks, bonds subsequently disappointed. But if you look at where bond yields are now, is this now the time to increase exposure to bond yields? Here to give us more insight on that is Brandon Quinn from Saffron Wealth. Brandon, thank you so much for joining us. And Maitsi Mutsuhani from Argon Asset Management on SA bonds. Brandon, yeah, you can come through. Brandon, you're up first. Thanks.
Okay. Good to go. Morning, everyone. Thanks for the opportunity of presenting to you guys. If the lights weren't quite so bright in my eyes, I'd probably recognize a few of you, but good to see you all. I'm here to talk on behalf of Saffron Wealth. We're a boutique asset manager in Stellenbosch. We've been around since 2012. And we demonstrate a macro quants, evidence-based investment management process that uses vigorous risk management in our portfolio construction to protect the downside. Important characteristics about Saffron is we own and managed. The key portfolio managers all have a profit stake in the outcomes of our business. So I think you can be guaranteed of the kind of focus that brings to a business. We're small enough to mean that the investments that we make do not move the market. We are able to enter and exit the market without much price effect, and I think that's also evidenced in the lower levels of volatility that we see in our funds. We've got about 3.8 billion under management, so from an AUM point of view, we're kind of large enough to make it a good business, but we're small enough to maintain our agility. What do we manage? Well, we manage funds across the spectrum, across the risk spectrum. Ordinarily, I'd be talking about our Opportunity Income Fund, which is our flagship fund, which sits in the low end of the risk quadrant, but we also manage a very attractive bond fund, the Saffron BCI Active Bond Fund, which I'm going to talk more about today. On top of that, we've got our Global Income Fund, which is a US dollar-based income fund based in Ireland. It's a UCITS fund, so it offers daily liquidity, and it's offering a really attractive yield north of 6% in dollars at the moment. We also have our flexible fund, which is our expression of our skill in the equity space, and that's growing very nicely, certainly beating the benchmark of the All Share Index. And then we've got two hedge funds, one of which is an on-commodity partnership agreement, which is not for, how we describe it is it's not for public consumption. It's our own money. And then we've got our qualified our QIF fund, which is also a hedge fund that we recently are moving across to Prescient from Sanlam. Okay, I always say, let's do the walk before the talk. What's our walk? If you have a look at our investment performance over 1 year, you can see we're certainly in the top quartile compared to the average. And if you look at our performance over other periods, the 3, the 5, and the 10-year, you can certainly see that our investment process delivers the kind of results that one would want. Importantly, these results are generated as much from downside protection as from taking opportunities in the market. What I've done here is we've put the active bond fund against an income peer group, and that's really because many of our investors actually invest in our bond fund as an income enhancer. And I think that's to a large extent why we've seen such enormous inflows into our bond fund recently, because of the attractive yields that it's offering. If we have a look at our bond fund in particular, obviously over 1 year we are one of the best performers. Over 3 years in its peer group, which is the variable term category, you can see it's probably the best fund in the country. Over 5 years and one of the best over 10 years. So what you're seeing is a very long track record through multiple business cycles, through multiple calamities in South Africa, but coming out amongst the best performing funds over all periods. If you have a look at our returns, I think barring the 1 year in the income space, we beat our benchmark, and our benchmark in the income space is cash plus 2, so it's not an unaggressive benchmark, and we beat that benchmark virtually over all periods. And certainly on our bond fund, we very much do beat the benchmark, which is the All Bond Index, over all periods. So I think, again, just to reiterate, what you're seeing is an investment process that really has proven itself over multiple cycles. And if you think about what our bonds have done, the volatility in those bonds, to maintain that kind of position, we think points to a very robust investment process. Amongst other things, and that includes credit, we're very active in the duration space. So what you pay us for is to position the fund to benefit from appreciation in yields, and of course to protect you against further sell-off in yields. And just from the chart above, I don't know how clear that is, you can see there, which is the black line, that's our active bond duration profile, and you can see the extent to which we position the fund. The All Bond Index has a duration of circa 5.8 years. We're sitting just north around about 4.5. So we are short duration relative to our benchmark at this point in time, but we are much heavier duration than we have been in a significant time. And there you can see that we literally increased duration close to 80% of the benchmark of the All Bond Index, and from time to time we have decreased the duration all the way down to circa 1.75 years. So we are very active on the duration front, and that's one of the key differentiators I think you'll see in this fund, is the fact that we are so active. Okay, down to our market views, and it is a mixed bag at best. We see the world as bifurcated, and it's not my word. I read it somewhere at some point in time, and it definitely applies to where we are right now. The US economy has performed, and at risk of just repeating what everyone else has said here, the US economy has performed remarkably well, and it's evidenced in all of the numbers that we're monitoring. The sources of that performance is obviously the fiscal or the COVID overhang, the stimulus that they pumped so aggressively into the market. Importantly, and that's the chart, the top chart on the right, we see a very good recovery in real wages in the US. And of course, bearing in mind that the consumer sector in the US is an enormous contributor to US GDP. So a rebound in real wages is a big deal. Obviously, I did mention the fiscal policy overhang, the post-COVID labor demand, and I think that's where the real wage impact is coming through especially, and of course the pent-up demand in the private sector that came through from COVID. What are the threats? The threats are everywhere at the moment, but probably least in the US. We've got, of course, the policy hiking overhang, which takes between 12 and 18 months to come through. So the full effects of that haven't yet been seen. What concerns me more is the impact on bank lending, because with these higher interest rates, banks are focused on reducing their provisioning, or bad debt provisioning, and of course tightening up credit standards. So the tightening of credit standards, I think, is really the gearing effect of higher policies. And what that means is that it makes US policies a far blunter instrument. In other words, it affects everything and not just interest rate sensitive counters. Another thing that kind of raises its head from time to time, but and then disappears, of course, is quantitative tightening. And there we've seen the red line there is the US in terms of its its borrowing relative to or the Federal Reserve balance sheet relative to GDP. And whilst the numbers in the US are enormous, they're actually quite small relative to their GDP. And they have the most scope to tighten without a major impact on their economies. The other economies, mind you, specifically the Eurozone, have far less wiggle room. Like one of the previous speakers said, you don't have to look too far to be bullish on the US economy and the US dollar. So their business system and their policy framework is certainly demonstrating a superior outcome to what we're seeing in other economies. Other parts of the world, effectively the US has insulated itself to a large extent. Also with some of their policies such as onshoring is going to strengthen their economy whilst transferring the risk to other parts of the world. So we've seen deteriorating terms of trade, and there, if you can see it clearly. I'm not sure about that. Real effective exchange rates in the rest of the world have deteriorated significantly. However, on the other side of that is, of course, the fact that a deterioration in real effective exchange rates means that our export competitiveness improves significantly. So hopefully, if you look at the chart, you'll see that in many respects, real effective exchange rates tend to be bottoming at this point. Hopefully, the weaker exchange rates are going to translate to greater trade economy exports. And in particular, if we see the US demand at least stabilizing, this could be a point of inflection for many global economies. Okay, so where to from here? We run what we call a Federal Reserve scorecard. What it does is it monitors about 80 different inputs, and it gives us an overall picture of what the Fed either is looking at but doesn't tell us, or should be looking at. And our scorecard tells us that much like going into COVID, the Fed was way behind the curve in terms of its rate hiking cycle. It's telling us now that the Fed is probably going to be behind the curve with regard to its cutting. What that means is that we expect interest rates in the US to be higher for longer. Unfortunately, I've been playing this violin for about a year and a half now, so sooner or later, you're going to get bored of the tune. And of course, the longer we write, the closer we are to being wrong. So we do believe that we are approaching the end of that view, and some of the numbers are bearing us out. If we look at the US FRA curve, it's expecting about a 50 basis point cut within about 12 months and about 2.25% within about a year and a half to 20 months, thereabout. So we actually think that the US FRA curve is starting to price perfectly in terms of our view. That said, none of us make money on where the market is at. We only make money on where the market is going to. So really, it's about what is the next step for US rates. If we have a look at the US 10-year versus 2-year, and that's an expression of effectively, the forward view on interest rates, as well as a view on the overall global economy, there's a huge degree of inversion. So the 10-year is about 1% lower, probably 80 basis points now, below the 2-year. That means that they expect both inflation and growth prospects to deteriorate in the long term, or over the long term. Right now, at these kind of very overextended levels, we would think that there's every reason to expect a normalization in the interest rate curve out of the US, and that includes both the 5-year versus 2-year, as well as the 10-year versus 2-year. Both are at very kind of critical points. And in that respect, the question becomes, well, is it going to be a bear steepener? In which case the long end needs to lift more, or it's going to be a bull steepener, in which case the short end of the yield curve needs to come down. Our view is that, and of course, the US 10-year is sitting at about 4.36% this morning. Those are buying levels for us. In our offshore fund, which has a duration of about 0.36 years, so very, very short for a 6% dollar yield, these are becoming opportunities where we start accumulating those long bonds. Not in big numbers, because you always have to be prepared to be wrong, but we certainly are increasing our exposure in the long end. And you'll see further on in the presentation that the importance of the US 10-year in our lives, in particular insofar as the yield curves of emerging markets are concerned. Okay, so let's translate that to South Africa. SA. We probably didn't hike enough. That's our view. If we look at more active central banks such as Brazil and other emerging markets, they were far quicker to raise rates, and they raised them a lot further. In this case, we're just going to compare them against Brazil. And Brazil raised its rates very, very aggressively. The implication of that was it raised its carry rate. And the way we manage our funds is very much from the perspective of an offshore investor. We look at our funds, because we have a broad investment universe, we can invest onshore and offshore. Approximately 25% of our funds now are invested in offshore interest-bearing assets. The reason is South Africa basically didn't offer us enough. We didn't raise rates, and that came through in the form of a weakening currency. The ZAR is, of course, more of a commodity trading or a commodity-based currency now than it's ever been. And as commodity prices come under pressure, and this is I believe it looks like a rolling one-year chart, you can see how commodity prices have been under tremendous pressure. Also, it is exhibiting what we call a basing effect. So in terms of historical performance, commodity prices do look like they are basing. And I can't stress enough the words look like they are basing. And in that regard, I think one of the previous speakers also said that we need a rebound in global growth in order to strengthen not only our economy and our fiscal flows, but certainly our rand. But on balance, I think we are seeing signals that these are approaching the kind of, let's call it, worst levels that can statistically occur. So if we think about our bonds, our South African bonds offshore, they really have exhibited an interesting characteristic, and that is the fact that they have sold off aggressively. But if you decompose them and understand the sources of that sell-off, what it shows us is that the majority of the sell-off has been caused by the rising US rates. So it's the risk-free component of our offshore bonds. And what that means, though, is that the sovereign credit risk premium, which is applied on top of US rates, actually has a little bit of risk or has risk embedded in it. That sovereign spread is really a factor of things like commodity prices and fiscal flows. And based on what I said earlier, it does appear like we are approaching levels that on balance, there's better upside in terms of profit than downside. This chart really just confirms that, and there you can see the blue line, which is our did I make it a 5-year or 10-year? Yeah, 5-year. That's our 5-year interest rate level in blue, and the black is, of course, the US Treasury 5-year. And there you can see that the blue line really is moving in line with the black line. SA rates are literally translating US rates in terms of our level. What it's not doing, and that's the red line, which is the 5-year credit default swap of the rand or of rand bonds, that really is actually quite tight. So that means that the sell-off in South African bonds is a result of US rates, not of South African credit. And that for us is probably the biggest risk component. But there are and should be mitigating factors that make it a safer bet than what one would otherwise think. And that, of course, like always, is excluding left field events that are brought about by politicians, etc., etc., etc. If we think about the South African fiscus, which is one of those kind of left field events, it is a concern for us. South African borrowing has kind of pegged itself just below COVID kind of levels. So that means that the fiscus is under extreme pressure in order to finance itself. And the charts on the right will show you that really the expenditure hasn't been trimmed as it should have been. So not only do we believe that revenue expectations are too optimistic, but we do know that expenditure hasn't been trimmed and probably will need to be trimmed in order to maintain our debt to GDP ratio at any kind of sensible level. So where do they get where do they borrow from? Recently, bond issuance has now started again in inflation-linked bonds. So we don't hold any inflation-linked bonds, and we're probably likely not to for a whole series of other reasons, which I'll get into. But South African Treasury is borrowing in the short end. So basically borrowing short-term treasury notes, 1-year, 2-year type notes, in order to finance the deficit. What is to our benefit is the bottom left-hand slide, which is our hard currency denominated debt, which although we did get some concessional lending, I think it's like 2.5% during COVID, that increased our net foreign reserves. But on balance, we are borrowing less in hard currencies than our peer group. And what that means then is that at least our debt is not subject to the vagaries of currency movements. So if we think about basket cases like Argentina in particular, their biggest threat is, of course, that they have borrowed a ton of money in hard currency, which means that as their currency depreciates, it really doesn't matter what the US interest rate was because they have to pay it back in a far cheaper currency. We always find this particular slide very useful, and what this is a factor analysis of all the drivers of our South African yield curve. The red bar is the effect of the repo rate. So that's the Reserve Bank increasing and decreasing the repo rate and its implication for the different components of the yield curve. And there you can see that as one looks further down the yield curve, the impact of the SARB's policy diminishes. And what becomes more important is, in fact, the black line, and those are US Treasuries. So where the largest economy in the world pegs their rate is, in fact, more important than where the Reserve Bank decides to place its policies. So if we think back to a couple of slides ago where we saw the 2v10, 2v5, 2-year versus 5-year, and we also thought about what kind of absolute levels those are at. And then we think about the implication for the South African yield curve, and we can see that statistically, the long end of the curve is determined more by US Treasuries than by domestic policy. These do appear to be good value levels in our domestic bonds if the biggest driver is in fact the US curve. Interestingly, though, the blue line, which of course is our, let's call it debt to GDP or net borrowings of the government, that has its biggest implication in around about the 10-year area. So those charts that I showed you earlier with regard to government borrowing, that's really the component, the piece of the curve where those numbers have the greatest effect. Another interesting chart here is the SA 10-year versus US 10-year spread. And you can see there that during the Goldilocks years, we really were only having to pay up about 1% over US rates. Then, of course, we had the taper tantrums, and that increased to around about the 5 to 7% area. That then came back, and now subsequent to COVID, we kind of are pegging it between the 7 and 9% level. So that means that a US investor looking to invest in South Africa in local currency should expect between 7 and 9% over their rates. Right now, it's looking relatively tight. So in many respects, what we need here to anchor the absolute level of our bonds is lower US rates. And again, I remind you about the previous charts and where those US rates are. So we definitely do need the US curve to come lower to support our bonds. The chart on the right shows net foreign purchases or sales of our bonds. And bearing in mind that this is on a calendar basis, so every year it resets to 0, you can see that over time, foreigners have been net sellers of our bonds. Statistically, mind you, we can prove that foreigners are a very bad trading signal with regard to buying and selling bonds. They do tend to get it wrong. However, what it does mean is that liquidity in our market starts getting thinner. And we have seen that. As the foreigners reduce their exposure to our market, the ability to trade our bonds does reduce. And we have seen that translating into higher volatility in our markets. And you will see that. The extent to which our bonds move has definitely increased over the last 3 years, and that's partially due to foreigners reducing their exposure to us. If we'll have a look now, just translating it into some of the metrics that we are probably more familiar with, things like the STEFI versus the ALLB. You can see there that the STEFI over the short term is starting to outperform the All Bond Index, but we believe that the ALLB is likely to outperform cash over the medium term. So over 1 year, yes, you know, our STEFI is pegged at fairly high rates, so it makes that difficult to beat, certainly on a risk-adjusted basis. But on a kind of 1 to 3 year view, we think our bonds are likely to outperform STEFI. So let's have a look at our curve. And what's interesting about our curve is how steep it is. That's the 2-year versus 10-year type ratio. Our view is we've been accumulating bonds in the 10-year and 15-year area, so really trying to capture the majority of that steepness. The All Bond Index, funny enough, or sadly enough, has a larger exposure to the very, very long end. And that means it's increasingly interest rate sensitive. Our view is that we can achieve the majority of the return of the All Bond Index without taking the kind of duration that's embedded in that benchmark. The other important thing about our funds is that we separate out the concepts of funding versus risk-taking. So our fund sits on a tremendous amount of short-end instruments, and we use those cash-like qualities to invest into bond derivatives. So we buy the long end to capture the higher yield and the duration effect, whilst at the same time sweating and getting the benefit of the short-end higher interest rates. In the offshore space, which we also are very active in, you can see there that we call them the SOAF bonds, the South African offshore bonds. Those have sold off certainly over the last 3 to 6 months. And again, this is very much driven by higher US rates rather than South African specific issues. Every now and again we see, country-specific issues causing volatility, but the majority of the sell-off has in fact been from US rates. Supporting our previous contention, which is that credit spreads are really our biggest worry there, are what we call asset swap spreads. And this is the embedded spread or rate that's used to discount those cash flows over the US Treasury rates. And you can see there that those spreads actually have come in. And that means that the credit spread in the offshore space of South African bonds is in fact relatively tight, and maybe a little bit too tight. But like I mentioned earlier, they can in fact widen, and maybe this is the time to talk about it. They can in fact widen without selling off in price. And how that actually happens is if US rates come down. So if US rates come down and our rates stay approximately where they are, the spread between those two rates expands and starts offering what we would expect to be more value or normalized levels. From our perspective, how do we take advantage of that? We use this phenomenon at this point in time to lengthen duration, buy up our yields at higher rates, wait for the US curve to come off, and then we swap those rates out into floating rate notes and capture a higher floating rate spread. So that would be typically how we would position ourselves for this kind of market. We can skip that one. Okay, locally, interest rate and inflation expectations. Inflation expectations, like in most cycles, economists all get herded into one direction, and we can see that the majority of economists in South Africa believe we're heading towards that 4.5% level, which of course is the Reserve Bank's target level, or implicit target level. We've got the explicit bands between 3 and 6%, but 4.5% really is what they target, and its consensus is that we're going to head towards that kind of number. Of course, the caveat, as it always is the oil price translated into ZAR. And there you can see the volatility of that translation in the chart on the right. And you will know that by the announcements recently of diesel going up by R2.20 and R1.90 and R2.50 and whatnot, it has a very, very real impact on inflation expectations. And this is what's informing our view that whilst we are bullish on the overall trajectory of inflation, we think that the oil price in particular is going to put a floor or upward pressure on those inflation expectations and is going to inhibit the SARB's ability to cut rates. In addition, it plays into our positioning, which is that, and I'll repeat it later, that approximately 50% of our fund is in floating rate notes, both on the income side and the bond side. So what we're positioning to do is harvest that short end, which we believe will stay higher for longer, and at the same time opportunistically enter longer duration bonds as we see value. This is what we call a base effect analysis. I won't go into the mathematics of it, but what it tells you that if all things stay equal, what is inflation likely to do? The confidence with which one can read this chart diminishes with time. And by that I mean it's probably accurate only for about 3 to 4 months, after which its information value diminishes. So what you can see there in terms of South Africa is that the base effects, and that's simply because we're coming from a higher number. It's difficult to keep adding to a higher number, and over time, even if it's if prices were to stay constant in 1 year's time, inflation is naught. So that's the basis of the calculation. But the base effects are in our favor. They're working against some of our peer group who have outperformed us in the recent past, such as Brazil. They are likely to have some base effect surprises. And of course, in the US, you can see the strength of that base effect coming through. So very much, the US just has to do nothing, and their inflation is going to transition to the kind of levels that they're looking for. In terms of interest rate expectations, we use the forward rate agreement or FRA curve in order to determine that, and we're seeing about a 50 basis point cut within a year. So, 50 basis points isn't a tremendous amount. What's interesting is how volatile these expectations have been. And there you can see the black line is where those expectations, or the black bar, where those expectations were a year ago versus how they've transitioned down. So this is typical of the top of an interest rate cycle, where those expectations completely reverse around and start pointing in the opposite direction, and the market is pricing for that, and in many respects priced to perfection. Okay, so our market summary. The Fed rate cuts are going to start in 2024, probably with at least a 50 basis point cut. In the short term, it's going to result in emerging market spread widening. So the spread widening doesn't necessarily mean losses for emerging markets. It just means that the relative differential between the two markets is likely to increase, and we see that as an opportunity. Chinese growth concerns, I think are ever present, not just from a geopolitical point of view with regard to Taiwan, but certainly in terms of their property market. Property development consumes a tremendous amount of commodities upon which we are so dependent. I've discussed the South African, the SA Fiscus vulnerability. So, that is also a concern. So our overall view is higher for longer. Longer is now shorter than it was a year and a half ago. But we expect to be able to harvest that short end higher yield with lower volatility for at least the next year, and use these opportunities to scale into longer duration to peg your investment at higher rates and get the benefit of that over time. So fund positioning. Strategically, we have more than, or call it 50% in floating rate notes, like I said. And tactically, we're sitting at 4.7 years versus an all bond index of 5.7 years. We have ammunition to extend that duration into extreme weakness tactically. So I think that's going to be, I'm glad we held back on being fully exposed to the All Bond Index. And again, on our Opportunity Income Fund, we're sitting at 0.9-year duration. Typically, our strategic duration is 0.25 years, so very, very short. So a 0.9-year duration is higher duration for us, but we do believe we're being compensated for that in order to capture those higher domestic yields. That's that. Thank you.
Hello, everyone. I'm Maite Motsonis. I'll be speaking to you today about Argon's product offering and our views on the global macro landscape. I think the interesting cross currents that are happening in the global macro space that we need to dig into and sort of like dissect a little bit and get a clearer picture of what's happening. So looking at our company background, we've been doing this for about almost 2 decades now. We have a track record, our shortest track record, which is the flexible income mandate, sitting at about 10 years, with the rest across asset classes, fixed income, equities, and multi-asset sitting closer to 20-year track records. We have a staff complement of about 37 people, and ownership structure, we own about 82% of our business. The next slide just shows a breakdown of that ownership structure. Staff owns 82%, with majority black ownerships, 73% of that, and 9% is representative of women ownership. Products under management, as indicated, we have capabilities to manage across asset classes, really equities, fixed income, multi-asset, and different variants and flavors of those different asset classes. Looking at our AUM split, we are predominantly an SA equities dominated book. So about 2/3 of our book is sitting in SA equities, with the rest made up of multi-asset and SA fixed income. You'll notice on the bottom right of the chart, we do have a couple of BCI products on the platform here. I'm particularly responsible for managing the BCI Absolute Return Fund. So moving along to the business of today, let's do a quick pulse check on the state of global macro. It looks like the market has been lulled into a sense of no landing or soft landing, and really I wanted to dig into the indicators that we look into and see, do we agree with this, or what is there something else at play here? So starting off with PMIs, so a plethora of leading indicators for months have been indicating that a recession might hit any time. And since then, recently, we've seen a bottoming of these leading indicators, indeed indicating that soft landing might be on the offing. Similarly, moving along to growth, we can see how this has translated into 2023 growth expectations in the US. And this is mainly driven by 3 factors in our opinion. We've seen significant fiscal stimulus, mainly on the back of the CHIPS Act, Inflation Reduction Act that was passed by Congress. And lastly, we've seen a manufacturing boom in the US economy. It's important to understand all of these fiscal measures were put in place at a time where the Democrats were in control of the White House, Senate, and Congress. So quite easy for them to put them through, and it might be a lot more challenging going forward, provided that we have a divided House and Senate. Even though we are walking into an election year, there might be some obstructionism and political posturing going into there. And then in the gray line, you will see that growth forecasts for 2024 remain pretty much pedestrian, roundabout. Started to tick up a little bit recently, but still below 1%. Looking at the inflation picture, inflation forecast topped out at around 4% earlier in the year, or around beginning in the year, and have leveled off around those 4.2% ever since. But then looking into next year, really next year inflation forecasts have been quite stable, around that 50 bp spread over the Fed target. So forecast at about 2.5%, the Fed is targeting 2%. So not really much worry about inflation going forward. It looks like a short-term story that we're looking at here. Moving closer to home, South African economic picture remains pretty bleak. You look at forecasts for growth in 2023, just over zero, sitting below 0.5%. Forecast to improve a little bit next year, but then that's still 1.3%. Pretty pedestrian, and it's not going to do much in terms of solving our structural factors, particularly around the fiscal picture. From an inflation point of view, we started seeing a top-out inflation forecast this year, just at the top end of the SARB target range at 6%, that have come in a little bit. Heading into 2024, we see inflation forecasts really not a problem, and they've trended towards the midpoint of the Fed's target range. So, casting our eyes abroad and looking at what's happening with US monetary policy. On the bottom panel, what I have there is a spread between Fed policy rate and spot inflation. So some crude measure of real policy rate. And you will see a steep repricing from that deeply negative rate, real policy rates that we saw sometime in 2020, 2021. To a level where we are sitting at comfortably around levels that are above historical mean, right? And you'll have to go back to the Volcker era periods in the early 80s to see these kind of moves in real policy rates. On the next slide, I tried to indicate to you that policy tightening has been aggressive, and we're starting to see signs of that. On the teal line there, what I have is the New York's Fed's estimation of real policy rate, also natural real policy rate. So think about it as R star, right? And then on the gray line, I have the 5-year US TIPS yield. You will see through time, over decades, R-star has tended to be a cap for the 5-year inflation linker, right? And you'll notice whenever those two series converge, it's typically around a time when we start seeing problems in the risk asset markets, right? So first convergence around the late 90s, early 2000s, obviously .com crash. Second convergence happened around the GFC of 2008. We obviously know what happened there. The second time we saw a similar thing was heading into COVID, and now it looks like the 5-year tip yields have powered ahead of R-star, which is worrying in my opinion. Looking at US monetary policy expectations going forward, you will see implied policy rate curve has shifted upwards. Obviously, with improving growth prospects, you will start seeing a lot of the cuts being priced out in outer years. You're looking at about a range of 40 to 60 pips worth of cuts priced out, 1 to 3 years out. From a financial conditions point of view, we have seen, interestingly, a sharp improvement in financial conditions since the bottoms in the first quarter around the US banking crisis. So you look at it, its bond market spreads have compressed. S&P has continued to power ahead. Cross-asset volatility has collapsed. So really easy financial conditions that we've seen in recent times. Probably the easiest we've seen so far this year. But then this is a very interesting picture that I see here, because you will not, you typically don't expect to see easy financial conditions in the face of a strong dollar, right? And you see here, I've put up the dollar against a spread between 2-year US yields minus an average of developing market counterparts, so Japan, BOE, and the ECB. Right. And you can see this interest rate differential indicators being pretty strong in driving what the dollar is doing. I might actually posit that what we're seeing here with money tight and fiscal expansion in place, this is very bullish for the dollar. Using the dollar smile framework to assess this, I can argue that the dollar is moving up the right side of the smile from that perspective. Looking at dollar versus positioning, interesting to also note with the recent uplift in the Dixie, we have non-commercial market participants positioning in the teal. You will see that this recent uplift in the dollar was faded aggressively by speculators, right? They are now at a point whereby they have cut back their longs in the dollar. They're sitting roughly neutral as we speak. So indicating there's a lot of dry powder there from a speculative positioning point of view, and if this trend in the dollar continues, there's dry powder to really turbocharge it. I have a couple of charts in the interest of time. I'll skip a couple of charts. Dollar versus commodities. Softer industrial metal prices continue to be a headwind for our local currency. The T line just shows the dollar rand on the right side inverted, and you will see how softer Bloomberg commodity prices. We're looking specifically at the industrial metal sub-index. The weakness there has really been a headwind for our currency. Interestingly, you don't see this picture on the broader Bloomberg Commodity Index. Just moving back to this slide, you're looking at the white line on top there, which really seems like it has started to correlate with the dollar of recent. And I think that has a lot to do with what we're seeing in oil. There being significant cuts in oil prices, inventory drawdowns, and there are some catalysts in place, and that can explain why we started to see some positive correlation between the broader Bloomberg Commodity Index with the US dollar. So looking at the US 10-year real yield, 10-year bond yield decomposed, there's a clear picture to me here at play, right? On the two lines above that sort of like track each other, I have on the right hand side the US 10-year yield. Overlaid against that on the left hand side is the 10-year TIPS yield. So in essence, what this tells you is this sort of like 30 to 40 basis point move that we've seen year to date in US Treasuries has been almost entirely driven by real yields. There's no inflation fear. As you can see, break evens, the white line at the bottom there, has tracked sideways. It doesn't tell me, look at this, just put this into perspective. When somebody tells me there's inflation fears and I'm decomposing the 10-year real yield and it's explained by a sell-off in an asset that is supposed to be protecting you against inflation, something really doesn't make sense here. So zooming out on that 10-year real yield, we can see that this is a C-thigma overshoot relative to its past, right? Relative to its past trend. So significant overshoot that we've seen in a short space of time. And for reasons mentioned earlier, the real yields have been held sustainably up there artificially. You can argue that fiscal expansion in the face of monetary tightening, you can argue that rebounding in productivity, a boom in manufacturing investment really has nothing to do with interest rates, and the Fed is forced to sort of like maintain a higher for longer stance in policy to offset what's happening on the fiscal side. Really, it must be mentioned, for the first time in since the post-World War era, we have seen this kind of pro-cyclical fiscal easing at this point in the cycle. We saw a little bit during Trump's tax cuts, but nothing like the magnitude we've seen recently. Another interesting chart that I've been looking at is US break-evens versus oil, which has decoupled recently. You will notice this is a very tight correlation. It's a relationship that makes sense economically. As oil prices rise, you would expect oil prices to have an impact on evolution of inflation expectations. But since around, say, mid-August, we've seen a decoupling between that, obviously driven by other factors around OPEC's cuts. But then you put this into perspective from a US inflation point of view, energy-linked goods in the CPI basket has peaked around 1970, and that was 9%. We have since seen that component of the basket drop down to 4%. So it is alarming to see this, but we need to take a step back and take into consideration that energy products are a lot less important for US inflation going forward. But then we need to keep an eye on this. It looks like break-evens are at a risk of breaking higher. From an inflation point of view, so we look at a number of inflation measures. So on the top, we have the US Cleveland inflation non-costing, just CPI year-on-year non-costing model. You can see that it's sort of like topped a little bit, sort of like turned a little bit, obviously with reflection that reflects higher oil prices. But then other measures, the Federal Reserve Bank of New York's underlying measure of inflation, they've been in constant decline from about 80 months ago, and we are seeing no signs of them turning as yet. And why is that? So the Federal Bank of San Francisco put out research where they split out and divided core PCE into two components: cyclical and acyclical. You can think of cyclical as the demand-driven components of inflation, acyclical on the other side, that's supply, right? As I've highlighted in the previous slide, you will see inflation topped out around roughly 18 months ago when the Fed started hiking. So the Fed really has nothing to do with the current disinflationary process that we're seeing. It was already happening if you look at acyclical inflation, and that is roughly primarily driven by easing supply chain constraints. The blue line, the cyclical component of CPI, has only started to turn now, right? Indicating that the aggressive tightening that we've experienced over the past 18 months is really starting to kick in. Shown differently, you can see acyclical peaked roughly 18 months ago, and we're only starting to see a cyclical inflation rollover. So, in essence, it goes back to my point, looking at the decomposition of US yields and how break-evens have tracked sideways. Markets are not worried about inflation. Something else at play here. So bringing things closer to home, let's look at South Africa versus 10-year yields. We have seen a sharp decline in our total risk premium, mainly, of course, driven by what has been happening in US yields and obviously our recovery from that spike during COVID. Although it is important to notice that this is still a healthy total risk premium, sitting at about 1 standard deviation above long-term mean. So quite some juice left in South African government bonds. Looking at horizon returns. So here I wanted to demonstrate how high the carry is in the local bond market. What I've done here is a simple exercise. I took yields across the curve, shocked them by almost 200 basis points. Oh, that number is 180 to be exact. You will notice in the blue line at the bottom, which shows a year out returns after that, you only start losing money on the 30-year ultra-long duration after close to 200 basis points of loss. So you can step into South African bond markets, be wrong a lot from an absolute return manager's perspective like myself. I get the comfort that a year out the carry will buffer me, and I'm likely not to lose money unless we see some crazy blowout in yields. I have some product performance numbers. Just know that these are GIBS verified. You can go at them at your leisure. I'm not trying to push product here. And I will close this presentation and open the floor for questions.
Right, gentlemen, thank you very much. Very insightful on bonds indeed, and hopefully the next 12 to 24 months are going to be super good for bonds. We are going to break now for tea. You can join us for tea. I'm not going to take questions in the interest of time. You're more than welcome to speak to them in the tea break. We're going to break for tea till about 11:50. If you can all be back here again and enjoy the scone and a cup of coffee tea outside. Thank you very much. Right, if you can all grab your seats. Right, for the second half of the day, we're going to start again with fixed income, but this time the flexible fixed income managers. On stage already ready to go is Sydney from Cadus Asset Management and Melanie Sockett from Laurium Capital. Sydney, you can go first. Thank you very much for joining us. Melanie as well, thank you for being here today. Thank you.
Okay, thanks Eugene. It's always good to be here. Really appreciate that. So we're still drifting in. So while we're drifting in, Eugene, just indulge me for a second. My colleague up on stage earlier, I see he used a lot of teal in his presentation, the color teal. And I don't know if that was intentional or contrived or anything like that. And then Cynthia this morning spoke about our nation is more divided now than what it was in the past. But man, this color teal is dividing the nation at the moment. It's a really well, good luck to our boys. Hopefully they win regardless what color they wear. Okay. Yeah. Okay, so often in our game and in our business, we are required to make judgment calls or really sound decisions in the fixed income game especially. I suppose the entire financial market game. And you know, it got me thinking that it's not always easy. It's quite difficult to make those sound judgment calls. And it's easier to make those judgment calls if you know what's going to happen. But that's why I entitled my presentation, what happens next, because we don't often know exactly what is going to happen next. And to make those judgment calls becomes quite difficult. Now, I think it's the Niagara Institute, they define sound decision making and sound judgment calls as one's ability to objectively assess situations or circumstances and using all the relevant information to apply past experience in order to come to conclusion or decision. That's a mouthful, but it does actually say a lot of things in terms of making sure that you use everything at your disposal, together with your skill set, together with your experience, to actually make the right decision. And I think you can agree with me, there's many things in the world today, many factors in the world today, especially in our markets, that's influencing the way in which we are moving, whether it's interest rates or whether certain markets are moving, whether it's equities or bonds or whatever the case may be. I'm supposed to be talking fixed income, but the macro factors are so important, and there's a few of them in the industry, or a few in the market at the moment that I'd just like to pinpoint. There's many forces at the moment, but we know that we've got global growth that's slowing down. Lots been spoken about it. The fight against inflation continues, and there's thankfully, I think, and we forget very quickly. Things happen, and then we forget, like the stress in the banking sector. Do we still remember? Yeah, we remember, but it seems to be out of the system at the moment. I think Evan this morning spoke about the availability of credit being quite tight. That's still in the system at the moment. China, we've spoken about ad nauseum, so forgive me if I mentioned it again, but I didn't know what my colleagues were going to talk about when I got here this morning. And then we also forget that the World Organization has said now the COVID pandemic is no longer a health emergency. So there's just a few issues in the system at the moment that can be quite pertinent and that can be quite relevant into the way in which we see this fixed income world that I'm supposed to operate in. But we all know what's happening right now. But what do we know? We know that the world economy is slowing. I think the average is about 3% is predicted for this year, but the OECD even says lower 2.7%. The United States growth level is declining as well. And then the euro area is, I think, even more pronounced. It's expected growth to be just under 1% for 2023. China, we've spoken about a lot. Will they buck the trend? Will they even get 5% growth? And then Japan has got its own issues. But we can see that, but where is it going to go from now? Is there any genuineness in this growth? Or is there more risk to the downside? And we can see that global demand obviously has declined, and the lagged effect of the appreciation of the dollar as well is also causing the declining growth and the decline in trade. And there's many more other issues. What's going to happen next? I think we have to wait and see. Don't be too hasty. Bide your time. We have to see how this growth issue plays out. But most certainly we know all the factors that are in the system at the moment. And I think it's going to take a while, and it's going to take a great effort to actually move oneself, for the world economy actually to move itself out of the current situation. Then, of course, we've got growth on the one hand, and then there's inflation. I know this has been mentioned before, but inflation is easing in most countries. But it seems to be divergence across, especially the emerging economies. And the core inflation is still fairly elevated. And in many of the emerging markets and developing countries, inflation is either still accelerating or is stabilizing at very high levels. So we've seen the major banks, and we'll know tonight as well, and we know our Monetary Policy Committee tomorrow as well, their rhetoric has been quite restrictive. So the question is, what happens next? What happens? Is inflation going to abate? As we know, base effects and all of those good things, we're still going to see some of the benefits of that coming through. Yes, we are going to see that. But of course, on the side where, on the other side of the coin, we've got oil prices that are going up, fuel prices that are rising, potential food prices increasing as well. And we've got all of those sort of pressures in the system that could delay or cause inflation to persist for a little while longer. So let's just watch out for that. Is China's recovery going to underperform? Yeah, at the risk of mentioning this again and again, we've seen the resurgence after COVID-19, then the sluggish consumer spending, the property market, and I think one or two of the speakers this morning spoke about that as well, the floundering property market within China, exports declining, and then their youth employment's quite high as well. Youth unemployment, let me get this the right way around. And then, of course, as a lot of countries around the world, they've got rising government debt. But why is China so important? What's the big deal about China? And yes, they are, because size matters in this instance. I mean, China's a very, very big economy, and of course, if issues start diminishing in terms of trade and in terms of their size and in terms of it affects the capital flows as well. So I think we cannot ignore China. I mean, I can spend an entire presentation on China, but what I would like to leave you with is don't ignore it, because that will help you figure out what's going to happen next. Okay, so that's just briefly the global environment. Locally, and I'm supposed to be talking about fixed income, but because economic fundamentals are so important in our game, we are also struggling with low growth. No doubt our growth is 0.6%. It's nothing spectacular at all, and it's really reflective of our fragile economy at the moment. Let me not even get into, and a lot has been said on this stage about Eskom and inadequate electricity supply and it being a major impediment to our growth. We've seen, at the last number, we saw a little bit of uptick in construction, I think it was, in manufacturing, but those are seasonal at times, and the cycle sometimes doesn't last as long as we think it's going to last. And we've got high unemployment, and we've got low business confidence, low consumer confidence. I don't want you to slit your wrist now, but those are impediments. That's the real picture. I have to paint the real picture to you, and this real picture says that we are still in the quagmire, and that's the right word, quagmire of growth, and it's a lot needs to be done to get out of that. So what happens next? Yes, tomorrow when you wake up, you'll still be in the quagmire of growth. It's going to take a while in terms of, now theoretically for your yields and bond yields in particularly, low growth should keep a lid on yields. We've got a bit of an anomalous situation in our setup in that lid that the theoretical low growth environment is supposed to keep on bond yields is being tainted by lots of negative sentiment at the moment. The sentiment from both abroad and locally is not that great. So unfortunately, bond yields, there's a bit of tension in the bond yields as a result of that. If it was that easy, low growth, lower bond yields, then it would be great. But there's so many factors at play. So our inflation, and this has been spoken about, it's in the target bands. I think it came out this morning at 4.8. I haven't been watching my screens, but I think 4.8, if you can correct me on the headline number, which was more or less where it was anticipated within the target bands. But we do have some risk on the upside. Now, food is issue, oil price above 90, and feeding through to fuel, second round effects of inflation, all those things. And that will deter from further inflation abatement. So what does that mean for yields? So even though we've got the lag, we've got the base effects, issue of the base effects coming through, and we enjoy that benefit, but that's going to run out. I can tell you that now. A couple of months ago, I think it was early in this year, I stood on this platform and I said to you, inflation is coming down. I can tell you that for free. So, and it has come down according to the numbers on the year-on-year number, because it's mathematics. It's not difficult to work out. Now I'm going to tell you that it's starting to run out. I'll tell you that for free as well. So by the towards the end of this year, beginning of the year, we're not going to be able to enjoy the lag or the lagged effect of, or base effects of inflation. So let's just watch that. And of course, embedded in bond yields, embedded in yields is inflation expectations. So we're at a precarious point at the moment where, yes, we're enjoying that. Don't be completely fooled by the fact that it's come down and base effects alone. There's still tension within the system. So, okay, I think the rand has been spoken about a lot today, but Let me just add and say that our currency has a tendency to affect our yields. Hold on to your hat, because I think we're still in for a very bumpy ride. We've got deteriorating government finances. We've all seen this very lately, of late, where a lot of talk is, a lot is being said about our budget deficit and a current account deficit and all of those things, and needs to be funded. Somehow or other, we need to, they need to issue more bonds, or whether they're going to issue, I think my colleague said early on, in the shorter space, the floating rate notes, the T-bills, I think is a little bit cheaper to do so, but hold on to your hat, because I think with the US inflation being sticky and the political noise before next year's election is also going to cause for volatility within our rand. Let me not mention China again, but we know that China is potentially also influential in terms of our currency. And I'll say this again, I say it on every presentation, the South African rand is a very liquid currency. It gets traded anywhere in the world, so the sensitivity to a local currency like ourselves, like the rand, is quite significant at times. Okay, so is the SARB, I think this is the question on everybody's lips, is the SARB going to cut rates, raise rates, or on pause tomorrow? Are they going to apply prudent monetary policy? Our house view is that they're going to pause rates, or that they should pause rates, and I think that the reason for that is, as I said early on, there's still inflation risk within the system, but if they're going to be raising rates now, I think they're really going to be killing growth to an extent where we're still battling with the issues I mentioned earlier on, consumer confidence, business confidence, unemployment, and all of those things. But knowing the governor is very, very astute and is very, very adamant that they will apply tight monetary policy if it is necessary and needs to be done. So the lagged effects that we've seen of the price of the rate hikes in the past is still filtering through the system. So hold on to your hat and buckle in for that as well. And let's not be too surprised if it is a pause tomorrow. One last thing I want to mention, one more thing I want to mention. I'm not going to be too long on the stage, but I think what's also coloring our fixed income environment at the moment is credit. And credit spreads have come down dramatically over the last couple of years. And I'm sure my colleague Melanie can attest to that as well, because this is a space we play in. And bank spreads, the only one that hasn't come down much is the municipalities. I mean, we all know why that is. So the people are at least thinking straight and saying we want more for the risk that we are taking part in when we invest in municipalities. So I get the feeling investors are selling their soul for yield. There's a big demand for yield at the moment. So as far as credit is concerned, a very interesting environment. I think investors need to be innovative in the way in which they approach yield, because the credit spread has compressed so much. It's causing quite a bit of tension across the board, whether you're buying bank paper or whether you're buying in the corporate market, or whether you're buying tier 2 or additional tier 1 paper. There's a lot of tension in the market because all of that yield is being chased at the moment to a huge degree. So watch that space carefully, and I think lots of innovation is going to be needed by investors and asset managers to be able to get decent spreads to obtain the kind of returns that they're looking for. So what's happening next as far as our bonds is concerned? I think there were quite a few schools of thought on this one on the stage this morning, but the short answer is yes. Bonds are offering a value, but you asked me and Mel over the last couple of weeks, it's been terrible because yields have actually been ticking up. The yield curve is very, very sensitive at the moment to negative sentiment. It's sensitive to the global environment out there. So I'd say yes, we've got, and I can go into detail, but time will not allow. But there is value in bonds, but you must be prepared to sit it out. And let me not get started on fair value models. I think I stood up here the last time and spoke about my thoughts on forecasting. It's not always very accurate. The main thing is stick to your investment process. Make sure you've got a trusted investment process. At Coades, we've got a process that's tried and trusted over the years, and it's depicted on screen by the bars at the bottom in that chart showing that we've been shorter or cautious for the last probably year and a half, and we've kind of just gone into that neutral territory now in terms of our positioning as far as our conviction level is in terms of which way rates are going to go. Very quickly, our flagship funds that we have that operates in the multi-asset space is our Enhanced Income Fund, the Reg 28 fund. And this fund uses credit, and it uses a big diversification strategy, and it's performed very, very well relative to its peers and its benchmark. Our other flagship fund is an absolute yield fund that uses duration tactics and uses duration strategies, and my colleagues have explained how that all works. We use a very active strategy in terms of our exposure to nominal bonds and corporate bonds, also credits, and to a lesser degree inflation in bonds seems to be out of favor at the moment, but this fund has also performed well relative to its peers. That just leaves me to say that at times we are faced with making judgment calls. We are faced with having to make sound decisions. But use your collective wisdom, use the experience that you have, use all the skill sets there, and think hard about when you make those decisions. So buckle up, guys. I think we're going in for an interesting ride, and I thank you for your time this morning.
Well done. Hi everyone, it's such a pleasure to be here with you today. So what I thought I'd talk about today is what's up with the yield curve. And why I chose this subject is that I seem to find that we as fixed income managers, when we present at these forums, we generally talk about bonds and the bond market as if it's a single investment decision. But does it matter which bonds you choose for your portfolio, and does that decision change at different points in time? Now the short answer is yes, otherwise I don't think I would have chosen it as a presentation topic. But what I wanted to share with you today was the reasons why and how this is important to bond returns over different periods of time. So just to start off with very briefly, what is a yield curve? So when we talk about a yield curve, we're graphing a curve of bonds that are very, very similar. So here I've shown you the South African sovereign yield curve. So this is the universe of bonds issued by the South African government, and they are all fixed rate bonds. The only thing that differs is the time to maturity. So along the x-axis, you will see time to maturity in years. So we've got short-dated bonds, 5-year bonds, 10-year bonds, all the way out to 30-year maturity bonds. And on the y-axis is the yield where those bonds are currently trading. So you'll have a look at this curve and you'll say, well, that's a very steep yield curve. You definitely get rewarded in South Africa for taking on time risk. So you get much higher bond yields if you invest for further longer dated periods of time. So does that mean that you should then only hold long dated bond yields in your portfolio because you're getting a higher yield? Well, maybe not. And let's have a look at some of the drivers of bond yields to help us answer that question. So you would have seen this framework before. When we're thinking about the factors that drive bond yield valuations, we think about it at Laurium in terms of our 3 Rs, which are our 3 fundamental valuation pillars. On the very left, very simplistically, we look at our risk-free rate. What is happening in the global bond market? So we're in South Africa. We're a very, very small part of a very big global bond market. And the biggest, most liquid, deepest bond market in the entire world is the US. So we use US bond yields as a proxy for the risk-free rate. We then, as we know, we're investing in South African bonds. So we carry a very different inflation profile in South Africa relative to the US. Our central bank targets inflation between 3 to 6%. The US Federal Reserve targets an average of 2%. So we have to make an additional compensation for the risk premium we want to earn in return for that additional inflation risk. And at the same time, very importantly, where we are in the current growth cycle and how the SARB is responding to inflation risks by using interest rates. And then the last factor is the risk premium for credit risk. So you're taking on the South African government credit risk. You're going to be repaid by the SA government, not the US government. So what additional risk premium do you require for that? Now, this valuation framework works in any cycle. So these are the factors that we think about regardless of which cycle we're dealing with. Now, Sydney and myself are old dogs in the bond market. We've seen lots of different cycles, right? So from let's start maybe the Rand crisis in 2001, global financial crisis 2007, 2008, the taper tantrum in 2013, We saw Nannygate, let's not forget how harrowing that was. Ramaphoria, the COVID crisis, the current crisis we're experiencing with load shedding, and so many other drivers in between. These are the factors that we think about regardless of the cycle. But what is important to bear in mind is that different drivers are more important for different areas of the yield curve. So this is an analysis that Nedbank have done. Very simplistically, they've taken 3 of those factors. They've taken US bond yields, which is the dark green bar for equivalent maturity bond yields. They've taken South African interest rates, which is the peach bar, and then the light green is a proxy for SA credit risk. They use debt to GDP as a proxy in this analysis. And you can see that depending on what the maturity of the bond is that you're analyzing, some factors are more important than others. So as you would expect, if you're looking at a 2-year bond, fair value for a 2-year bond in South Africa, the primary driver is going to be your forecast on short-term interest rates. Whereas if you were valuing a 30-year bond yield, you can see all the way to the right-hand side, the most important driver, you are hoping that in 30 years' time, you're going to get repaid, you're going to focus more on credit risk. So yield curve positioning, does it matter then which bonds you choose for different points in the cycle, depending on what your view is on those different drivers? And I'm going to illustrate the answer to that by using 3 consecutive calendar years. So I'm starting off with 2020, I call it the COVID epicenter year. Feels like a long time ago, but let's cast our minds back to what was happening in 2020. What I've shown on this chart is 3 factors. The gray line at the bottom is US 10-year bond yields, the proxy for our first R, our risk-free rate. I've also shown 2 SA cyclical factors, South Africa's inflation rate in red, year-on-year inflation rate, and then SA interest rates in blue. And if you look at the carve-out or the gray block, that's the 2020 calendar year. So what happened in 2020? COVID hit the global economy, and policymakers went into triage mode. The patient was going to survive no matter what, the patient being the global economy, and they threw everything at it. So if you think of monetary policy, we saw interest rates being cut to incredibly low levels. We also saw an extraordinary amount of liquidity being thrown at the market from central banks. At the same time, fiscal policy was deployed in scale. Do you remember Ben Bernanke years ago talking about helicopter money? We saw that in COVID. Money was literally given to US citizens and citizens of other countries, so fiscal policy came to play. And what that meant for US bond yields, the risk-free rate, flight to safety, as well as all of this extraordinary accommodation, saw bond yields fall to all-time lows. We've never seen that level on US bond yields before. So it fell all the way down to not even 0.5% for a 10-year bond yield. What happened in South Africa? Our Reserve Bank, also like any other central bank, went into emergency accommodation mode, cut interest rates as quickly as they could. And South Africa inflation in red was incredibly well behaved. We didn't have an inflation problem. Remember the SARB target's 3 to 6%, and we were actually flirting with the lower end of that range. So no inflation problem in 2020. But the issue we did have as bond investors was that because we saw this large contraction in growth, we saw recessions all around the world. In South Africa, there was a large negative fiscal implication from that. Growth dropped, so the revenues that we were earning from the economy dropped. Our expenditure was high. We had additional COVID-related expenditure on top of that, and it meant that there was a large fiscal shock. In fact, in 2020, National Treasury were guiding us that debt to GDP, which was around 60% and below, was expected to spike all the way to just under 100% debt to GDP. So we were facing a fiscal risk, a jump in fiscal risk premium. So what happened to the yield curve? So what I've shown here is the yield curve at the beginning of the year, that's the green dotted line, and then the yield curve at the end of the year, which is the blue line, the blue solid line. And what you can see is that there was lots of action everywhere across the curve. So the shorter end of the curve rallied, yields fell. Remember in bond world, if yields fall, the price rises, so that's good for bond returns. If yields rise, the price falls, that's bad for bond returns. And we saw the curve steepen on both ends. So interest rates falling supported shorter dated bond yields, but this jump in fiscal risk premium meant that longer dated yields spiked higher. How did bonds do in this year? The All Bond Index returned 8.7%. That's a really good year, despite the fact that in March of that year, we saw a minus 9.7% total return for that month. Bonds recovered, and bonds as a whole gave you 8%, 8.7%. But where you were positioned across the curve was of critical importance. If you look at shorter dated bond yields, 1 to 3 year maturities or 3 to 7 year maturities, you had a fabulous year. 3 to 7 year bucket gave you 16.3% return. I mean, that was amazing. But if you had only been holding bonds that matured greater than 12 months in your portfolio during this year, you would have had a very anemic return of 4.6. What about the following year, 2021, the COVID recovery year? What were the factors that were driving bond yields? If we start with the first R, global bond yields, the US 10-year Treasury, yields had lifted a little bit, but still at very low levels. The Federal Reserve, if you remember, despite the fact that inflation in the US was trending higher quite quickly because we saw all the global supply bottlenecks, the Fed was saying, you know what, guys, this is transitory, nothing to see here, don't have to worry about it. And they did nothing. They continued to flood the market with liquidity and keep interest rates low. What happened in South Africa was that we saw inflation start to lift a little bit, still very well within the target range, but we've got a very credible, very committed inflation targeting central bank who are very prudent, and they started to lift interest rates towards the end of the year. So if inflation was moving up, they said, time for this emergency accommodation has passed, and we're going to start to lift interest rates. And at the same time, we had a very positive dynamic through our terms of trade, and all that means in South Africa, terms of trade is the prices of the commodities that you export relative to the commodities that you import. So the prices of our export commodities, it's platinum, palladium, iron ore, rhodium, those all bounced to incredibly high levels, and oil was well behaved, so that opened up in our favor, was really good for our fiscal position. We got corporate tax receipts from resource companies, which helped to repair our fiscal position, and we also saw a current account surplus from these high export earnings, which gave us a really useful shield against quite a tricky global backdrop. So what happened to the yield curve? Once again, the dark blue line beginning of the year, the orange dotted line at the end of the year. Interest rates are rising. The market is pricing in a tightening cycle. We saw short-dated yields rise, whereas long-dated yields, because of this fiscal reduction in risk premium, we saw long-dated yields supported. Orbi, All Bond Index, once again, gave you 8.4%, a great return, but one you had to be careful where you were positioned. Short-dated yields underperformed quite significantly, but long-dated bond yields were the outperformer. So yield curve positioning, once again, really, really important. 2022, I call this the almighty global bond sell-off with a capital A. I do that for a reason. I'm going to very briefly show you what happened to global bond returns. You'll remember 2022, that was the year of war. So Russia invaded Ukraine. Oil prices, food prices went to sky-high levels, literally adding fuel to the fire of what was already a difficult inflation picture in the US. The Fed didn't have the luxury anymore of just tapping the brakes gently. They had been behind the curve. They had to slam on the brakes. Inflation was rising. US bond yields rose from very low levels in a very short period of time to much, much higher levels. And we saw global bond returns. This is the global aggregate index, so it's investment grade, a good proxy for if you're looking for global bond returns and what they've done. You look at this index. This shows you returns every calendar year going back more than 20 years. And if you look at the red line, that was 2022's return, and it was literally off the charts. And why was it so bad at minus 16%? For two reasons. The first one was that going into 2022, bond yields were at very, very low levels. Now remember, with a bond return, you've got two components, the yield component, the coupon clipping part of the equation, and then you have the change in the yield gives you a capital gain or a capital loss. There was no cushion because yields were so low, and there was a large rise in yields, so big capital losses with nothing to offset it. Those two components gave you very negative bond returns on the global stage. What happened in South Africa? Because food, oil prices, both big parts of our inflation basket, we had an inflation problem. Inflation rose, went well above the top end of the target range, and our central bank responded as they should and very quickly removed this accommodative monetary policy. What did that mean for the yield curve? It meant that yields rose across the curve. Short end because interest rates were rising, the long end because we had this big rise in global yields. Orbi didn't have a great year, 4.3%. Yield curve positioning helped a little bit, but there wasn't really a sector that significantly outperformed. So where are we now in 2023? This is a very interesting time for us as bond managers, and we say, like, what is next, Sydney, is that we're at an inflection point for many reasons. The first one is that this big rise in global bond yields, it's still volatile, we're still not out of the woods, but a large part of this rise is behind us. US Treasuries are back to where they were prior to the global financial crisis. A lot of value has been restored, so that's less of a headwind for us. Secondly, South African interest rates, if they're not at the peak already, which we suspect they probably are, they're very close to that peak, so it's an inflection point in monetary policy. The issue we have, which you would have heard a lot about during the course of today, is that we've got some South African specific risk factors in the bond market. Growth is very low because of load shedding. At the same time, commodity prices have fallen significantly, so we don't have that tailwind from terms of trade any longer. That means we have to price in a higher risk premium. And then we've had these lovely geopolitical risk factors like the Lady R and so on during the course of this year. That's why we have such a steep yield curve. That's why longer dated yields are so high. Do we see value in the curve despite these risks? And what's interesting, when I think about presenting this to you, I can build a story for why there's value across the entire curve. Right now, the shorter dated yields, the ones that I've highlighted in grey, for different reasons, because monetary policy will be changing, because we're going through an inflection point, there will be capital gain opportunities to be had in certain pockets of the shorter end of the curve. And the longer end of the curve, because yields are so high, when we spoke about that total return cushion that you have as a bond investor, that cushion is very fat, very high yields. You can stomach a lot of capital volatility and still have very good returns. What does this mean in an income fund, though? So obviously in all of our multi-asset funds, we're expressing these views. In an income fund, it's more conservative. We can't express too much of a duration view. Most of the strategies are the base of that pyramid, cash enhancement strategies, but as and when we see value in the bond market, we can include bonds in the portfolio. We measure that with duration, within a duration risk budget. We can't go higher than 2 years. And just to show you how we've actively managed that over time, we have actively been lifting that duration component. And when we started to stretch our legs towards the right of the chart was when we saw this big rise in global yields, much better value, much less of a headwind from global yields rising. We could really express our view in terms of bond selection across the curve. Has this worked over time? I'm out of time. My marketing, Mike's probably going to throw something at me. But I just wanted to leave you with one thought on this slide. We've got a very long track record, 106 months that we've shown you in terms of this total return history, and 100 of those months, 96% have all been positive returns. During the COVID period, when the All Bond Index was down 10%, we were only down 2%. We think that's very compelling, and we bounced very quickly thereafter. And we're right up there in terms of risk and reward relative to the best performing peers in the market. So thank you very much for your time. Really appreciate it.
Many thanks, Sydney and Melanie. Definitely a lot of moving parts in the fixed income world. So if you don't want to make those calls, then have a look at their funds. Thank you so much. Right, the very last session for the day, and probably a lot of excitement for a lot of you out there, multi-asset flexible. So that's where a lot of these things come together in terms of fixed income and onshore or offshore, or do I have more bonds or more local equity? We've got three presenters this afternoon here. Joining us and coming through to the stage now is Nick de Vos from Centaur Asset Management, Paul Bosman from Granite Asset Management, and Chantal Baptiste from Fairtree. You can all come through. Thank you very much. Just very quickly, maybe, on the Centaur side from Nick, they're going to focus on their balance fund, but they also have a SA multi-asset flexible fund, so a fund that are not Reg 28 compliant. But it's capped on the global allowance, but it's more flexible, most definitely. Similar to on the Granite side, they've got a balanced fund mandate as well as a multi-asset flexible. On the Fairtree side, Fairtree manages a range of funds for us called the Select Funds, or Select BCI funds. Chantal's going to focus on the equity carve-out, which is the main driver of those funds. So one of the funds she's going to look at is the Fairtree Select BCI Cautious Fund, but she's mainly going to speak to the equity carve-out, but that also applies then to the balance mandate as well as the Select BCI Equity Fund. Nick, you are first, so you're more than welcome to start. Thank you very much for being here. And Paul and Chantal, thank you.
Great. Thanks for the introduction, Eugene. Okay, so my topic is multi-asset high equity. Centaur is a very simple business. we only have two funds, so it's the Central Balance Fund and the Flexible Fund. And then later on, or actually next month, we'll be soft launching an SA Equity Fund and then officially launching it the month thereafter. So business was founded in 2000, three principles: delivering investment excellence with outstanding service and with the utmost of integrity. We only have 7 billion of assets under management, being around 23 years. And if you look at the performance of the business, you would typically think that the AUM should be much bigger than that. But the reason is that we are a retail-only asset manager, so we don't take on institutional mandates. We've got a tightly knit team. And then, as I mentioned, we'll be launching an SA Equity Fund later on this year. And if anyone wants to talk about that specifically, you're more than welcome to come and speak to me afterwards. So here's just the long-term track record of the business. So what we've done here is we've broken up the track record into 4 different buckets. So typically, we've managed to outperform by about 3 to 4% per annum. And then the second bucket there was during the 2008-2007 financial crisis, where it's typically a bit easier to come by alpha. There's a lot more dislocation in the market. And there we did about 9% per annum over that period. Our investment philosophy, so I'm going to give you an example instead of trying to explain it to you, but we call it dynamic value creation. The example here is Fiat Chrysler. It's typically seen as a bad industry, the auto industry. A lot of guys avoid it entirely. But what we try and do is we try and identify value creators in businesses. So it's a theme that you'll see in most of our large holdings, similar to Aspen, where we think Stephen Sard's a value creator, John Elkann, which is mentioned here, but he's a value creator at Exor. So the two value creators here were Sergio Marchionne, the CEO, and John Elkann, the chairman. What they identified was in that period 2009 to 2014 that the European auto market was subscale relative to the US. So they built a strategy that they were going to scale up and consolidate the market. So Fiat acquired Chrysler for minimal consideration over that period. The Balance Fund built a position in October 2014. And then over that period, Ferrari was unbundled. That subsequently went up 7 times. We didn't hold Ferrari through the entire investment period. We sold it out and bought a business called Exor, where John Elkann's the CEO. Then after that, in 2019, they sold a parts business and declared a special dividend. And then more recently, the business is now called Stellantis, which is the 4th largest automotive manufacturer in the world. And they created that by merging Fiat Chrysler with Peugeot. And the strategy there was to build a scale EV platform and to essentially get the technology that Peugeot had developed. So we recently actually sold out of this position, but over the investment period generated 22% per annum relative to the MSCI World of 10% per annum. So just a bit of macro. I'm sure you've all seen this slide before, but essentially this is the US yield curve. Now, I'm not saying it's going to happen this time. I actually thought we might have a recession in the US already by now. But typically when the yield curve inverts, it's been a very good historical signal of the US entering a recession. So you might ask, why don't you hold a 0% equity content if you think the US is going to go into recession? Because quite frankly, this time, it could be different. We don't have a crystal ball when it comes to macro indicators. It's something that you probably would have heard a lot as well, is that typically everyone's waiting for the US to start cutting rates, and this might be positive for the equity markets. But this is just an illustration that every time that the Fed has cut rates, because they typically push them too hard into a slowing economic environment, that's usually a signal that something's potentially broken in the market and the equity or the S&P legs down a bit further. So over all these periods, the average is around 26% that the S&P falls when the Fed starts cutting rates. Then just the SA outlook. I did mention we are launching an SA equity fund. I think it's very kind of popular to be negative on SA at the moment. I'm not saying things are going to get much better, but over the past 5 years, GDP has been, essentially not growing, around 0.5% per annum. And all we're really saying is that the economy coming off of a very low base and a few self-helps potentially grow 1 to 2% per annum, which isn't enough. We should be growing at 4 or 5% per annum, but there is a bit of a tailwind potentially for equities over the next 5 years, which there wasn't previously. So just mentioning here, we're seeing some structural positive signs emerging. There's a couple bubbles there that I'm not going to read to you, but you can go through them. Wilson Bailey reported results last week. They're sitting with record order books in South Africa. We had a meeting with them a couple of months ago, and this is the first time in many years that they haven't had a single piece of yellow equipment in any of their yards. It's all sitting on construction sites. And then there's just a few SA Inc. positions. Altron, Reunert, Curro. I've actually had management meetings with all of them this morning, but I think those three are quite exciting ideas, and I'm happy to discuss them in detail if anyone wants to have a chat about them afterwards. But all three we've bought in the balance fund. Altron probably buy a bit more, and then Curro, I think we, in a pullback, probably top up as well. Then this is something that we show quite often. So this is just an interest rate model. So if you test this back historically, if the Reserve Bank cuts interest rates by 1.5% or more, that's typically the time to be overweight equity content. And if the Reserve Bank raises rates by 1.5% or more, then that's typically the time to be underweight equity content. So if you backtest this, if they raise rates, typically the SA market's given you no return, and in a cutting rate environment, the market's given you the 20+% per annum return. So all the indicators currently say now is not the time to be overweight equity content. So in terms of that SA equity fund, timing might be a little bit off, but we're taking a 5-year plus view and launching that fund. Then just the central balance fund's current asset allocation. So I've already mentioned we're quite negative on equities in terms of the US, a little bit more positive on SA. We do use some of the local, we do use offshore to substitute a bit of the local SA equity content. So you'll pick up a bit of a dislocation there if you look carefully at the numbers. But overall, we're underweight equity content. In terms of bonds, we're in line with where the benchmark currently is, but more recently, we're slightly underweight. Yes, there's very good real yields on offer, but as the previous speakers mentioned, we are quite concerned about the fiscal situation that the country's in. We're sitting with quite a big offshore cash holding here, the 9%. We're getting 5% on real yields, not real yields, but 5% hard currency yields there. We think is quite attractive, and it gives you a lot of optionality. So if the US does sell off, typically what will happen is you'll get EM currencies that blow out. So maybe the rand goes to 22, 24 to the dollar, and then we'll use that to bring currency back and buy SA shares, or we'll potentially deploy that money in the offshore market. Then here's just our strategy. So we defensively positioned, as I mentioned, the bonds duration I've mentioned. We have actually been taking a bit of profit in some of the offshore counters. We've had a couple that have run quite hard. I'll go through our three largest holdings now and give you a bit more detail there. Some of the resource names that have been pulling back, we have been topping up. African Rainbow Minerals, Anglo American. We haven't had any platinum shares for quite some time, and we're not topping up that. We're playing that via African Rainbow. And then we are buying SA Inc. shares. 3 of them I've mentioned to you. There we think you can potentially do 25% per annum kind of returns. And then I've mentioned the currency. Then here's just a breakdown of the balance fund's asset allocation kind of return that it's generated. So we've done about 1% per annum if you had to break out what the kind of active asset allocation has done above the benchmark. The bonds, we really just try and track what the benchmark does there. So it's more or less in line. We use it as an asset allocation tool. SA equities, where all of our returns have really come from. And then MSCI World, we've slightly outperformed. I think actually a very good kind of scorecard to put that up, considering we haven't owned any of the very big, large tech shares that have really pulled the index up. A few large holdings. So Aspen, still at the top of the list. We think Steven Saad is a value creator. I'm sure you've seen in the headlines, there's a lot of announcements coming out. Yesterday they announced Novo Nordisk, where they'll be filling capacity at their PE plant and essentially packaging insulin for them for export and supply into the SA market. They're sitting with a strong balance sheet. He built the business through acquisitions. That we see that engine starting to go again. Then there's still a lot of excess manufacturing capacity that he can fill across the business, both in SA, France, and we think if all those things come together, and he continues with this acquisition strategy that he's done successfully in the past, typically get around 20% odd, off of a bit of a low base, but earnings growth per annum over the next couple of years. And then Absa Truworths, I'm not going to go through into detail. Offshore, Exxon, I mentioned Don Elkin. We think he's the value creator there. Which may be interesting about it is it trades at a 45% discount. So, you probably would have heard the discount narrative a lot with Naspers and Prosus. But what's actually quite attractive about a discount is you can buy back your own shares. It's a very easy way for management to create value without doing actually much effort. So if you're buying back your shares at a 45% discount, you grow your net asset value per share around 4% per annum, depending on the quantum. But I'm basing it off now a recent buyback that they've announced, and that's a very easy way to add additional growth onto a business. Dell's had quite a bit of a run of late, so they're being caught up in this whole AI theme. I guess what's maybe a bit different here is they're actually earning revenue out of it. It's not just a story. And then Flutter is one that we used to hold a business called Entain. We didn't like what management was doing there, so we switched it into Flutter, which has done quite well. And essentially, what we like about the business is they're leading online gaming business. They've got a brand in the US called FanDuel, and we think that's going to drive very strong growth over the next couple of years. Then this is just the balance fund's track record. So in the red is the balance fund return. The dark grey is the benchmark. It's a composite benchmark that we create ourselves. The intention of that benchmark is to beat the average in the category, which it's done. And then, over a long time period, 10 years, number 2 fund in the country. And then here's just an illustration of if you had to blend the balance fund with the largest, I think it's 4 funds in the country. I mean, I'm sure you can all guess who they are. And over this time period, you would have delivered a additional, call it 0.5% per annum with lower risk. Conclusion, so 2023, we're off to a good start. I think our performance remains quite robust. We haven't really changed anything. Processes are all working. We continuously review all our positions, asset allocation, and then that point about now being the time to opportunistically buy SA Inc., I think is quite valid. And then offshore, despite we're quite negative on the macro, I think the businesses we hold are still quite attractive. And then there's contact details and a disclaimer if you want to have a read. Thank you.
Everybody, thanks for having us on the stage here today. I'm a bit worried about my presentation. I've sat through 3 presentations now, and I don't have a single chart. I think I've got 2 numbers. I think there are 2 numbers. There's the number 10 and there's the number 3.45 somewhere. So I'm from the madhouse that put this down on your table. I saw a payslip. I'm not a payslip. A grocery bill a few months ago of 1994, and it just struck me when I saw what it cost. In 1994, you could have bought the whole house as groceries for a week for 130 rand. And it just hit me and knew that's what we investment professionals are doing with our lives. That is what we're doing. And then I did a bit more arithmetic and realized that if a proverbial George, not this George, a much younger George, started working in 1994, and was probably 22 at that time, put his first contribution to his RA in 1994, he's still working, he still hasn't spent that money, which means that that money must have been invested so that it's increased tenfold, and he's still got another 10 years to work. It's quite a staggering responsibility. So if a basket of groceries goes up 10 times in 30 years, then you've only managed to match inflation. Now you haven't even enabled George to retire well. You've only managed to fight inflation. You've only managed to preserve buying power. So how do we do this? Well, we use equities, but that's not easy. Where's the actual? But that's not easy because picking stocks is hard. From 1926 till 2022, only 3.4% of US stocks created all the wealth in the US. It's a staggering number. So we sit picking stocks all day. It's a very, very hard thing to do. I bet if you know someone who's made a lot of money on the stock market, they actually didn't make money on the stock market. They only probably own 1, 2, or 3 maybe companies that they held for a very long time. And it would be a Capitec or a Naspers or a Microsoft or Apple. That's how you make money on the stock market. It's not on the market. It's buying companies that have got some kind of a competitive advantage on a strong growth vector, and you keep it. So how do we do this? We think that 3 truths, absolute truths in markets, and they're timeless, and we try and harness them. The first one is that many companies will fail. If you think about the previous slide, effectively 96% of stocks didn't create any wealth. And then secondly, a few companies will compound. Very few companies will compound fast. And then finally, emotions do exist in markets. They've existed in all markets over all times, whether it's the tulip market or the spice market or the flower market in Cape Town. I mean, there's emotions, depending on whether it's Valentine's Day or who's been smoking what. So there will be emotions in markets, and these are the 3 things you need to harness. Okay, so if the emotions in markets, just buy cheap companies. That could work. If you want to buy growth stocks like a Capitec, a Microsoft, Apple that I've mentioned, just buy the growth companies. But now the problem is the first one, many companies will fail. If you're buying cheap companies, often they're cheap for a reason. And if you're buying companies that are growing fast, often industries that are growing quickly attract capital, and the profits get competed away. The first one is called a value trap. There's a trap, there's a reason why it's cheap. The second one is mirage-like. You never actually make that money. It's always there. You always think, I'm going to be compounding soon, but the profits keep under-delivering, and that's because it's being competed away. So what we try and do is provide for this. You can harness these strengths, but you actually need a process that harnesses it. You can't just buy cheap companies, and you can't just buy growing companies. So we first try to find companies that we want to own, companies that are robust, companies that we think will not fail. When we find those companies, we can then express our views through those companies. That means that if emotions exist in markets and you're buying out of favor companies, find companies that are actually going to survive and then buy them when they're out of favor. Don't just buy companies that are out of favor. It's a completely different odds of success. If you have a portfolio of good companies and some are attractively priced, but they will survive whatever challenge they're going through, it's very different to where some won't survive. And you're probably going to keep buying more of the ones that fall, and that is a value trap. So if you find companies that are growing fast, then be very sure about the competitive advantage and be very sure that they're reinvesting in that competitive advantage. BlackBerry was ahead of Apple at a point, and Apple absolutely killed them. And that was because Apple kept reinvesting in the competitive advantage. Fantastic, strong growth vector, multi-decade, a lot of money to be made. And BlackBerry blew it because they tried to just push the same product over and over, but they had to actually reinvest. So to really get those true long-term compounders, there must be a competitive advantage, and they need to reinvest in that competitive advantage. The Microsoft you buy today is not the same Microsoft that you bought in 2002. Not at all. It's a completely different business. But they kept reinvesting on the growth vector, which is effectively enabling individuals and businesses by means of software. These are the people. It's our investment team. It's a small team. We've got a broad skill set, even though it's a small team, which means we've got people with a lot of experience in bonds and in property and in domestic equities and in global equities. That's not important. What's important is that we talk to each other quite a lot. We talk to each other all the time, And when you've got a small group of people who talk to each other a lot, there's tremendous benefits in it. My colleague here, he's a nature conservationist. He tells me trees talk to each other. So trees can tell each other there's a drought coming, there are insects coming, and do whatever they need to do to survive. And trees have been pretty good against the evolutionary onslaught. We think exactly the same is true for investment teams. If you talk a lot, you know how to optimize, where to focus. What goes into the portfolio is the result of very robust debate. And if you have too many people talking, well, then it's quite hard to listen. So we think this is a very well-resourced team. And when we do what we do, it makes us very, very happy. Thank you.
Afternoon, everyone. I think I stand between you and lunch, so I'll try and make this quite brief and punchy. Fortunately, it's equity, not fixed income, so it is normally generally more exciting. My name's Chantal Baptiste. I'm one of the equity portfolio managers at Fairtree Asset Management. So as Eugene pointed out, I am presenting on the BCI, or the Fairtree BCI Select Cautious Fund. And as you can hear by that title, it doesn't sound very much like an equity fund. So this fund, there's a 35% equity carve-out. So that's the piece that I'm going to be talking about. I think myself and Bradley, who is the portfolio manager in this fund, we're going to be presenting on one of the BCI Wednesdays. I think it's the 18th of October. So he'll be unpacking the other building blocks of it. I'm going to be focusing a little bit more on equity. Who of you were here in, I think it was April. We were here in April this year. Was it May? Feb. Who of you were here in Feb this year? Raise your hands high just so you get a bit of breath. I would have made you stand up. I stood up here and I was very convincing. I think I missed my calling as being an economist, where you're 100% correct 50% of the time. And I told you two very important things. China was going to reopen very, very strong, and it was going to be amazing. 1.4 billion humans going out and consuming. And then the second thing I told you was there's no ways that the US or the developed part of the world can take interest rates from 0 to 5% and nothing happens. I was very convincing, I believe myself. And we got those two things completely wrong. Completely wrong. Thank goodness I'm not an economist, I'm an equity portfolio manager. So as long as I get the equities right, I still need to think a little bit about the macro. And we're trying to scratch our heads and understand, why did we get this wrong? I also included a few more pictures in my slides than numbers, and I love looking at the cover of The Economist because I find them the masters of the obvious. They always state stuff that's already happened. I love reading it. It's one of the subscriptions I do hold. It's very interesting to get a very nice in-depth knowledge across the entire world. But the first one there, the exit wave, that I think was a publication in January or February this year. So just showing that post-zero COVID, China was going to reopen and we'll have this massive impetus into the rest of the world. And then I think 2 months ago, they printed that one at the bottom with Xi Jinping riding a snail and just saying, you know, it's been an absolute damn squib. Nothing has really happened. The roller coaster ride there was also, I think, in March this year, saying that you cannot take interest rates with a delta of 500 basis points and nothing happens, but nothing has really happened. In February, March this year, we had the US regional banking crisis, and at Fairtree, we thought we were quite smart, and we said, you see, we knew something would crack and break, and gold, which we had put in the fund for that very reason, did incredibly well, and we tapped ourselves in the back and said, yes, we got it right. The Fed stepped in, and then we continued as though nothing had happened. So we continued to get that wrong. The top there, this alternative world order, this is something that's really come to the fore over the last 18 months, and it has really been the East rising up against the West. We have the BRICS that are growing in numbers. We're now going to invite the Saudis, the oil guys, into the fray, and also some of the LATAM guys, which are just big economies, lots of humans, lots of resources. And the BRICS starts to grow and get bigger, and it pushes against the US. You would have all heard about this big de-dollarization narrative that's bandied around. I do think it's there. It is definitely a headwind, but it's not something that's going to happen potentially in our lifetime or even our kids. It takes a very long time to dethrone a currency that strong. but it will continue to move against the dollar and against the US. And this is where you've seen the US come out, and they know they need to do something. Remember, they can't have full-blown sanctions against China. Why? They need China. China produces everything that the US consumes, and vice versa. China needs the US because they consume everything they produce. So it will be this continued passive-aggressive stance. And then lastly, there at the bottom, why inflation will be hard to bring down. Our base case is that global inflation will remain structurally high for longer. Now, we called inflation probably about 3 years ago, and the underpin there pre-COVID was that we had gone into this deglobalization type of trend, where we had the Trump administration come in and rattle the cage of the Chinese, and we knew that countries were starting to close up and trying to produce things themselves. Now, if I'm a gold-producing country like South Africa, and this gentleman here produces maize, and I can do it at a unit cost much lower because I have the gold and I can mine it efficiently, and you have the mealies and you can produce maize much, much more efficiently, and we trade. That's efficiency. We've been in that trend for the last 4 decades where we've been trading with each other. You do what you're strong at and you trade, and it benefits the whole world. We're now busy reversing that. So that was our base case. Then there's the demographics where people are staying older for longer. You'll see it obviously clearly in your industry, where you thought and you premised that people should die at, say, 71, 72, based on 15 years ago. Then the actuaries come out and they say, actually, they're living longer, modern medicine and the likes. We need to adjust how they save and how they spend. This is a phenomenon in your world, and I'm sure that you are seeing it. When you have more aging humans and less humans coming in, less humans actually being bred, especially in the developed part of the world, and they're not coming in, they don't want to drive trucks and pack shelves and all of those things. Not millennials. They don't want to get their fingernails dirty. So you don't have this working force coming through to replace that labor force. That's very, very inflationary in nature. So this is where we think we are in the inflation cycle. That hump there is what Jerome Powell told us. Inflation will be transitory. It will peak and it will come down because it will be based on goods inflation. A lot of that is fuel. It's the cost of oil going up, and it's also the very basic definition of inflation, which is too much money, people sitting on savings, not going into the office because of lockdown and COVID, getting furlough, chasing too little goods, China locking down and the world not having enough access to goods. We think we're somewhere there where that star is, and we think inflation has come down somewhat, but we think it will remain elevated for some time. We think the Fed is going to continue to hike because we think monetary mechanism has broken down. I'm not going to get technical on you. I also sometimes don't understand that stuff. I'll leave it up to the fixed income guys to explain it. But very simply put, this is where it's broken down. Now think about it. You get 2 mechanisms as a government to bring inflation down. One is fiscal, and very basically that's the transfer of wealth from the government's balance sheet into the private sector. Then you get monetary. This is the part that hurts us, the man on the street. How do you get people to spend less money without physically taking it out of their bank account? You make their key asset more expensive. You increase interest rates, so your bond repayments become higher. So instead of paying 10,000 Rand a month on your bond, you're paying 20,000 Rand a month on your bond. It means your disposable income dries up, and you can't spend that much more. You can't go out to the cinema, out for drinks. You conserve and you stop spending, and naturally that will bring goods inflation down. That mechanism is broken down in the US, and that's because they have a 30-year fixed mortgage rate. So right now, if you're in the US, you're paying what that black line is, 3.6% for your current home loan. Now, if I live in Manhattan and I get married and I have a baby and I'm living in a 35 square apartment, tiny, I want more space and I want to move out. I'm currently paying 3.6%. If I move out, I sell my apartment and I buy a house in Brooklyn, how much am I paying? 7.5%. Now, as a South African sitting at the tip of Africa, you'll say, hold my beer, what's 7.5%? We're used to paying 13% for our home loans. It's not much. For US people, it's a hell of a lot, and it's the delta again. It's going to double. So instead of paying $1,000 a month, you're paying $2,000 a month. So what this means is that US people cannot afford to go out and buy a new home. So they're sitting on their current property. If they have to move, they go and rent somewhere and rent their current property out. out. So it means that mechanism is broken down somewhat, and the Fed will have to continue to bring inflation down by this monetary policy, increasing interest rates. If we cast our eye to China and what we got horribly wrong at the beginning of the year, this is, I think, a slide that I actually showed you. And all it is household deposits, so the amount of savings that the Chinese people are sitting on, 19 odd trillion RMB, versus what the lending that they're taking out, 5.2 billion RMB. And what I said to you at the time is that 19 odd billion is going to have to find a home somewhere. So they're going to go out, they're going to care, they're going to spend, they're going to travel, they're going to buy stuff, they're going to buy new cars, they're going to take out new home loans. And they haven't done that. They've done nothing. Why is that? There's no confidence in China. Why is my pointer not working? Oh, it's this thing here that's not working, sorry. It's my screen. We look at a different screen down here. Flip, this BCI conference in Durban, I dropped my mic. Now, pointer's not working. Setting me up for failure, Eugene. So this one here, all you're looking at here is confidence levels in China. It hasn't been this low in 26 years. Think about yourself. When you look at data, apply a reasonable mind, especially consumer data. Think about yourself in China. If you were in China right now, you're a human being. We're all the same. We think in a similar way. You've gone through the last 2 years where your leader, imagine Ramaphosa, he went and decimated your key industry being property. He decimated it, hurt you. It hurt property developers. Then he went and said to you guys, we're going to be the first to lock down. Remember, they were the first that went into COVID and locked themselves down. They're the ones who led the rest of the world into that. Then he opened it up quite quickly and said, now go, rock and roll, do what you want. Then he came out and he said, listen, we might side with Russia in this whole thing. We're not quite sure. Slowly but surely, you start to lose a hell of a lot of confidence in him. Then he went and said, zero COVID. We're going to beat this thing. We're going to go into a much harder lockdown. Now you're sitting there and the rest of the world is having the best time of their lives. They're all traveling, buying luxury, moving around. You as Chinese people are sitting in your tiny apartments, and if you leave your apartment, you get arrested. It's militant, okay? Your children get separated from you if they have a fever and you don't, and they go into a strange hospital. Then he says to you, go out, now we reopen, and plus, I'm leader for life. I am leader for life, I'm a dictator. How would you feel? You lose your confidence, and what do you do when you lose your confidence? What do we do in South Africa when we've lost our confidence in this country? You don't invest here. You sit on your cash and you externalize as much as you can. That's what all your clients want to do. Every time they come to you, they say, please just take it offshore. I don't want exposure here. The Chinese people can't take it offshore. Very different exchange controls. So if you can't do that, you do what Ramaphosa did. You put your cash in a mattress, okay? And then it's safe. Then it's safe. Then no one's going to touch it. And that was the disappointment that's come through in China this year. It hasn't been as strong as what we thought. Now, Xi wants to achieve 5% growth this year. He's not going to get there. He can fix the numbers, and he often does that. If he doesn't like the data changes, the unemployment rate, the youth unemployment rate sitting at 27%, he doesn't like it, so they're not going to publish it anymore. Okay? He does what he wants. To get there, he's going to have to do some type of stimulus. This isn't our base case at Fairtree. We don't think he's going to come out and start to build a whole lot of stuff and iron ore is going to go through the roof. It's not our base case, but it is a possibility. So we are still invested into China, but we're playing more the consumption angle. We're going through luxury and we're going through tech. Bear in mind, this fund is 100% JSE listed. Scary, I know. We haven't taken our offshore allocation since inception over the last 11 years. And that's because we actually have a hell of a lot of opportunity on the JSE. The JSE offers you tons of opportunity if you can see opportunity. Now, we equity investors, not fixed income investors. We don't defend, we offend. So we need to see the opportunity when it's not there. We need to see what's the next available opportunity. And I'm going to end there because I know that Eugene thinks I'm going to run over time. I just wanted to point one thing out, and I think that our dear friends at 361 did disclose something similar after they saw my slides in Durban. But this is an analysis of the Eskom plan, okay? I'm not going to go through all the slides, but it's very, very powerful. The blue at the top is what Eskom can do, or what the government can do. It is very conservative, okay? I've kept the EAF, the energy availability factor at 56% into perpetuity. My base case is that what Eskom will provide the country from a generation perspective is stage 2 load shedding into perpetuity forever and ever and ever, because they have to mothball some of their power stations. They want to bring 6 to 7 gigs back on stream over the next 2 years. I think that's too optimistic for the government. Okay, so I've cut it in half. They can fix Kuberg. They can maybe bring Medupe 1, 2, and 3 back on stream. It's built. It's just a chimney that's missing, and maybe they do one or something else right. Okay, let's not give them too much glory. It's just fixing what they already have. What is very powerful is that green bar there. That is the private sector. And what you have, if you look at the bottom there where it says surplus and deficit, I know it's a lot of numbers, but 2023 is going to be our worst year from a load shedding perspective. On average, 6 gigs mismatch. Sometimes it's 7, sometimes it's 4. You're going to feel it, and remember this, in December, it's our biggest month for maintenance. So expect towards the end of this year, load shedding will get much, much worse. Don't be surprised when it happens. Remember what I'm telling you right now. It's going to get much, much worse, and then it will improve. The government brings something on stream next year, and then the private sector, 2025 onwards, they bring a wall of energy, most of it renewable. Another important thing, I've been at a conference this week, and I met with Kapalship. Everyone freaks out when they hear that name. It's like Mufasa. You don't like it. Kapalship. Remember the guys that wanted to bring the boats or the big ships with gas? And I actually spent a lot of time with them, and I know you're going to scoff at this, but I actually think we need them. I don't think they're that evil and bad. The biggest issue with them is they wanted to lock us in for 20 years, and now they've renegotiated it, and they're going to lock us in for 5 years. It's a take or pay, meaning if we don't take the energy, we have to still pay for it. But they're going to be bringing 1.3 gigs of baseload. Natural gas. So it's not renewable, it's baseload. It's consistent, 24 hours a day, into 3 different areas, Saldanha, Kruger, and Richards Bay. And they're charging R1.5 per kilowatt hours. How much does Eskom generate energy at? R1 per kilowatt hour. So they're not charging us an arm and a leg. It's actually quite affordable energy, and they can get that up and running in 9 months. From the moment we get the approval, and they're waiting for one last approval. It's got to come through the IPP approval process. Should be December this year. Meaning next year, this time, 1.3, which I haven't included in here, it's not anywhere in here, could come on stream. And it comes on quite quickly, and you can ramp that up. You can actually add to it. So just be careful what you read in the media, okay? Spend a little bit of time, go Google Kapalship, look at all their projects across the world. It's not as evil as what we potentially think it is. And that's the end of the presentation, Eugene. I'm not going to go through all the slides. I just maybe wanted to point out that the proof is in the pudding. This is our performance in the equity fund since inception, November 2011. We've outperformed our benchmark, being the CAPSWIX, by 4.6% per annum net of fees. Okay, net of fees, not before fees, net of fees. And that's above the benchmark. So it's not absolute 4.6, it's the benchmark plus 4.6. And then there's just this makeup of the cautious fund, and you can see at the top there that turquoise, 35% of this fund is the equity fund that I just spoke to you about. Importantly, their performance is also outstanding, about 2% outperformance per annum, and then you can see the 3-year, 5-year, 1-year track record. But if you want any more information on this fund specifically, the lovely lady at the back there, Anna Marie, she can give you all of the information that you need. We'll also be around for lunch. Thank you so much for your time, guys.
Always great to start with Evan and end with Chantal, isn't it? Right. Ladies and gentlemen, thank you so much for being here today and your continued support. And on behalf of Olga, Robert and Tanya, thank you so much for all you do for us. To our lovely presenters right through the day and our team on here, Paul, Nick, Chantal, thank you so much for great content. If you need any more information, like Chantal said as well, they've got their own team, or get hold of Olga, and she can give you all the information you want on the funds. We mentioned our new website, the Boutique Manager website, where you can find all the content of all the BCI partner fund managers, the podcasts, presentations, recordings, fun fact sheets, the whole kit. If you're not sure where it is, give us a call. We'll show you where it is. And keep an eye out for our BOW sessions again, where we keep you updated on what's happening in the world. Thank you so much for being here. Thank you to our presenters, and we'll chat to you soon.